So hello all my dearest students of South India. I hope you all are doing good and your studies are going on great. So here we come up with another revision video in full English for CA Final Direct Tax relevant for May 24 and November 2024 exams. Okay. So today we are going to complete lot of topics like taxation of various entities, profit link deductions, MAT, AMT, penalty, set off, carry forward, dispute resolution committee, alternative investment fund and securitization trust. These are the topics that we are going to cover in today's revision video. Okay. So let us start with the first chapter for today's revision video, and that is taxation of various entities. In this we are going to first of all talk about a cooperative society who is going to get deduction under ATP. A cooperative society is allowed deduction under ATP. 100% profits and many other incomes are deductible under ATP for a cooperative society. Let's see which all incomes are deductible over here at 100% rate. First of all, point number 1 has 7 points over here. The 7 points, all of them are related to some or other kind of business income, and these incomes are 100% deductible under Chapter 6A. The first one, if a cooperative society is engaged in the business of providing credit facility to its members, it is 100% deductible. Yes, this deduction is not available to a cooperative bank. It is only available to cooperative society. Further, but if you are a primary agriculture society or primary cooperative agriculture and rural development bank, then this deduction is available to you. It is available to you, but it is not available to a normal cooperative bank. Okay. Next, cottage industry, this deduction is definitely available. If a cooperative society is engaged in marketing of agriculture produce which is grown by its members, which marketing of which product? First of all, the marketing should be of agriculture product and it should be grown by its members. If it is grown by its member, then it is 100% deductible over here. Next, if the society is engaged in purchase of agriculture implements, seeds, livestock, for what purpose? For supplying to its members. For supplying to its members, then also it is 100% deductible. If a cooperative society is engaged in processing of agriculture products of its members. How? Without the aid of power. Very important. If it is without the aid of power, then it is 100% deductible. Next, if a cooperative society is engaged in collective disposal of labor, it works like a manpower recruitment agency. If it is engaged in manpower recruitment agency where it disposes the labor at different places, then it is 100% deductible. And last but not least, fishing and allied activities. The second point covers also some kind of business activity. There is a cooperative society who is engaged in supplying milk, oilseeds, fruits, vegetable, which is grown and raised by its members. So they are supplying certain products which is grown and raised by its members, and they are supplying to federal cooperative society, or they are supplying to another government or local authority, or they are supplying to government company or statutory corporation. And what are these people doing? These people are supplying this to ultimate public. So there is a change. So a member is growing, giving to society. Society giving to federal cooperative society, and federal cooperative society is giving to ultimately public. Then it is 100% deductible. Okay. Next, if a cooperative society makes an investment in another cooperative society and earns interest and dividend out of it, interest from loan and dividend from shares of another cooperative society, then that is also 100% deductible over here. Okay. Last but not least, if a cooperative society let out its godown and warehouses for agriculture purpose, then the income from rental income will also be what? Deductible 100% over here. Apart from this, a cooperative society also gets a general deduction, but you have to be very careful with the general deduction. I am telling you some very important point with respect to general deduction now. But before that, let's see the general deduction first. If you are a consumer cooperative society, then you will get a general deduction of 1 lakh rupees. And if you are any other society, then you will get a general deduction of 50,000 rupees. But this general deduction is only available against other business income of the society. It is only available against other business, other than the above business. If other than the above business, if the society is engaged in any other business, then this 50,000 and 1 lakh can be deductible against that. Last but not least, if you are claiming ATP deduction, then AMT is not applicable on ATP. AMT is applicable on all profit link deductions except ATP. On ATP income, AMT is not applicable. Be very careful. Okay. The next discussion, the next entity, cooperative society is done. Let's talk about the next entity, and that is film producer and film distributor. Now, how the cost of production or the cost of acquisition, cost of production for producer and cost of acquisition for the distributor, how that will be allowed as deduction under the income tax law. For that purpose, the government of India has made two rules, Rule 9A and Rule 9B. The government says that if the film is released before 3rd Jan 2024, then the entire cost of production or cost of acquisition will be allowed as deduction. Entire will be allowed as deduction. Okay. Entire. If the film is released before 3rd Jan 2024, you close your eyes and take the deduction of entire 100%. Okay. What if the film is released after 2nd Jan 2024? Okay. It is released after 2nd Jan 2024. Then depends. Then if all the rights are sold, if all the rights of the film are sold, then also claim entire cost of acquisition, cost of production, entire. If all rights are sold, claim entire deduction. But if all rights are not sold, and if it is released in the last 3 months, that is after 2nd Jan, listen carefully. If all rights are not sold and if it is released after 2nd Jan, in that case, you will not get the full deduction. In that case, you will get the deduction of cost of acquisition, cost of production, compared with the amount which is realized by the producer or the distributor by selling the rights or by exhibiting the movie, whatever it is. Okay, you have to compare both of them, and whichever is less will be allowed as deduction to you. Okay, so you have to be very careful. If the rights are fully sold, then you will claim full deduction. But if the rights are not fully sold and if the film is released in the last 90 days, that is after 2nd Jan 2024, then you have to check the cost of production with the amount realized. Okay, otherwise you don't have to check that, because in 3 cases you are going to get the full deduction. Sir, cost of production will not include certain thing. If any movie is made by you which is financed by some portion by the government, then that much portion has to be reduced from the cost of production. Okay, so that much portion you have to reduce from the cost of production. Secondly, cost of production will further not include 2 things. It will not include the cost of the positive prints, and it will not include the cost of advertisement. It will not include the cost of advertisement also. Okay, these 2 expenses will be allowed fully as revenue expense in the year of release. Whenever the movie will release, in that year these 2 expenses will be directly allowed to you. Okay, you don't have to think much about it, whether it was released in the first 9 months or in the last 10 or in the last 3 months. Whenever it is released, in whichever year it is released, it will be fully allowed. Last but not least, that is if the film is not passed by the censor board, and if the film is abandoned, then the expenditure which the producer has incurred, whether he will get the deduction, the answer is yes. That will be treated as a revenue expense under section 37(1). Don't worry about it. Okay, let's move on to the third entity, and that is mutual concern. What is a mutual concern? It's a group of few people coming together providing benefits to each other. It is made for the mutual benefits of few people. So few people, 10 people are coming together for the benefits of themselves. Now there are 2 types of mutual concern. One is normal mutual concern, one is trade and professional association. Normal mutual concern is like social club, etc., and trade and professional association is like Bombay Chartered Accountant Association, Doctors Associations, Lawyers Association, Trader Association, etc., etc., etc. Now how both of them are different? For trade and professional association there is a specific section, but for other kind of associations which are general association like social club, residential welfare association, for these people there is no separate section. Okay, now let me tell you the provision of this. Suppose there are 10 people coming together. I am talking about the other social clubs, etc., first of all, and then I will talk about the trade and professional association. Let's talk about other social club, etc., first of all. Suppose there are a group of 10 members who are coming together to make a club. Okay, now everybody is contributing some general receipts. Every month they have to contribute some money to the club. Okay, now whatever money is received from the members, the general receipts received from the members is exempt, because members, we are receiving the money from members and we are giving the services also to the members. It is a mutual concern. Okay, similarly, if specific services are giving to members, then that is also exempt, because we are taking money from members, we are providing services to member, that is also exempt. But specific services are provided to outsider, now there is no concept of mutuality, therefore now it is taxable. Be very careful. Okay, in trade and professional association, as per section 44 capital A, it is slightly different as compared to the left hand side. How it is different? Let me tell you. General receipts from members is separate, and receipts from members and outsiders for specific services have a separate treatment. In the left hand side, even receipts from members for what specific services were exempt, but in the right hand side it is not exempt. In right hand side, only general receipts from members minus general expenses, whatever is the surplus, that is exempt, and whatever is the deficit, that will be allowed as deduction against this PGBP income subject to some condition. Okay, now let's come to the right hand side. Okay, receipts from members and outsiders for specific services minus expenses will be called as PGBP income. Okay, now whatever is the deficit on the left hand side, that will be allowed to be set off against your PGBP and other income also, subject to only 50% of total income. For example, this deficit is 1 lakh and this income is how much? This income is 1,50,000 rupees. Then you will be allowed to set off this 1 lakh against this 1,50,000 to the extent of 50% of total income. And suppose if your total income is only 1.5 lakhs, then out of 1 lakh you will be able to set off only how much? Only 75,000 rupees, not more than that. Now before doing this set off, if there is already some brought forward loss in your business or UAD, you have to first set off that, and then you have to set off the deficiency of this 1 lakh rupees. Be very careful. Okay, for this purpose we have done some questions in the class. You can go and check that in your textbooks. Okay, now let's go ahead with some case laws which are there. There are some housing societies who are taking some transfer charges from the members. So whether the tax will be charged or not, no, there is a principle of mutuality over here. Similarly, there is another housing society who is taking some transfer charges, incoming charges and outgoing charges from the members. for the benefit of the society. Incoming means if a new member is coming to the society, they have to pay some charge. If the new member is if the old member is going out of the society, they have to pay some charge. So that is known as incoming charge and outgoing charge. Will that be subject to income tax? Again, the government said that no, there is a concept of mutuality here. We are taking from the members. We are providing the services to members only. There is no concept of non-mutuality. There is a concept of mutuality over here, and therefore no income tax will be charged. Okay. Similarly here interest earned on surplus of a club deposited with institutional members. So now if you are depositing your money at some outside institution and you are earning some interest out of that, then that is not concept of mutuality, and hence that will be subject to tax. Okay, it will be subject to tax under the income tax law. So the rule is very simple. If you are providing services to members, okay, and receiving money from members, then there is a concept of mutuality. In resident welfare association, in resident society, cooperative society, there is no concept of taxable, there is no concept of profitability over there. There the entire objective of making a society is to provide services to the members. That's it. There is no concept of what? Earning some money out of it. Now let's move on to the biggest part out of all the topics in this chapter, and that is taxation of firm, including the LLP. Whenever the word firm will come, the LLP will also come, except few sections like 44 AD, where firm is there, 44 ADA, where firm is there, but LLP is not covered in those two sections. Okay, in 44 AD and ADA, LLP is not covered. You have to be very careful with that. Let's talk about taxation of firm now. For firm, you need to be following few sections. First of all, from section 184 to 189. What does this section say, sir? Section 184 says that if you want to assess yourself as a firm, then there has to be a deed, and there has to be an individual share which is mentioned in the deed. Individual share has to be mentioned in the deed. Secondly, when you will file the return for the first time, you have to accompany this deed along with the return. Along with the return, you have to send this deed. And when you will file the return for the first time, you have to certify the deed by all the partners, not minor partner. Okay. And later on, if there is any change in constitution, it means if there is any admission, if there is any retirement in the firm, then you have to give a revised instrument along with the ROI to the income tax department. Okay, be very careful. These are some technical requirements that you have to follow as per section 184. If you don't follow this, then you will not get the deduction of interest and remuneration which is paid to the partners. Okay, so whatever interest and remuneration which you pay to the partner, it will be disallowed in the hands of the firm, and then it will be exempt in the hands of the partner. Partner will not be liable to pay tax on that because it is already disallowed in the hands of the firm. So partner will not be liable to tax on that. Okay. Next, there are three sections that we need to see one by one. 187, 188, 189. What is 187? 187 talks about change in constitution of the firm. What do I mean by change in constitution of the firm? Change in constitution of the firm means there are three partners, A, B, C, and suppose one of the partner goes and another partner comes. A, B, C is there, C went away, C retired, and in place of C, D came. Okay, so now the name of the firm is ABD. So will I file two income tax return? The answer is no. There will be only one income tax return, but later on, whenever the tax liability, whenever the notice will come for this financial year, all the four partners will be jointly and severally liable as per 188A. So whenever the notice will come, A will be liable, B will be liable, C will be liable, and D also will be liable, because 188A says that every person who is a partner in the previous year, even for a single day, will be liable for all the dues of that year. So if you are a partner in a particular financial year, even for a single day, you will be liable for all the dues of that financial year. Okay. Next, section 188. This talks about succession of firm by another firm. What do I mean by succession? Succession means all the partners suddenly change. If all the partners suddenly change, that is known as succession. Suppose initially three partners were there, A, B, C. Now all three of them retired and D, E, F came. So instead of A, B, C, now D, E, F came. This is known as succession of the firm. So if there is a succession of the firm, two separate assessments will be done. Okay, for predecessor and for successor. Okay, so predecessor will file separate return, successor will file separate return, and predecessor partner will be liable for predecessor firm, successor partner will be liable for successor firm. Next one, section 189, which talks about dissolution. Dissolution is very dangerous. Whenever a dissolution happens, every person who is a partner at the time of dissolution will be liable for all the dues of all the years of the firm. So if today dissolution happens and if I am the partner, all the dues which are pending of the last 10 years, I'll be liable for all the dues of all the years, irrespective of whether I was partner in that year or not. Okay, irrespective of whether I was partner in that year or not, because I am a partner at the time of dissolution, I am liable for all the dues of the firm. This is a very, very dangerous part under the income tax law. Next, now come to something very, very important. From here, the important part of this chapter starts. The very first thing that we need to understand over here is 40B. Remuneration and interest deduction will be allowed to the firm subject to some condition. First of all, remuneration is allowed if it is paid to working partner. If it is paid to sleeping partner, it is not allowed. Interest is allowed to any partner. Remuneration is allowed only if it is paid to individuals, human beings. Interest is allowed if it is paid to any partner, human beings or even to company. If the company is a partner, interest is paid to a company, then that is also allowed. Now, both of them should be authorized by the deed. Sir, what should be written in the deed? There has to be at least for remuneration, at least specify the amount of remuneration, or if you are not able to specify the amount, at least lay down the manner in which the remuneration will be computed. Okay, that even the CBDT has said that you have to mention either the amount or you have to mention even the manner. Either of the two has to be mentioned in the deed. Okay, for rate of interest, you need to mention the rate of interest in the deed, and the rate of interest should not be more than what? Should not be more than 12% per annum. Okay, now last but not least, both remuneration and interest should not be retrospective. It has to be prospective. It cannot be from a behind date. Today is October. I cannot say that I am ready to pay a remuneration from 1st April. That is not allowed. From April to September, remuneration will not be allowed under the income tax law. Okay. Next, a CBDT circular is there that you don't try to inflate your profits and take deduction under 80IA. If you do that, then the AO will what? The AO will recompute the profit under 80IA. We will talk about this later on under 80IA. Not relevant over here much. Okay. Now coming to the next point. Novel distributing enterprise, Kerala High Court judgment. What does it say? Suppose there is a firm and there is a partner, and in the firm deed it is written that partners are eligible for interest on capital account. Now if I am paying interest on current account, whether the deduction will be allowed or not, the answer is no, because the deed very clearly says that the partners are eligible for interest on what? Capital account. Deed does not say that the partners are eligible for interest on current account. If the firm wants deduction on both, then both has to be specifically mentioned in the deed. Otherwise, you are not going to get the deduction. Now, interest, I have told you how much deduction you will get for interest. It is 12% per annum. But what about remuneration? Remuneration will depend upon book profit. Sir, how the book profit will impact the remuneration? If the book profit is negative, then the remuneration will be 1,50,000 flat maximum. If the book profit is positive and it is up to 3 lakhs, then 1,50,000 or 90% of book profit, whichever is higher. Okay, this is the maximum limit. This is not the stamped limit. It will be compared with the actual remuneration and whichever is lower. And on above 3 lakh, if the book profit is above 3 lakh, then on balance book profit, 60% of the book profit will be allowed as remuneration. So what is book profit? Book profit is nothing but PGBP only. It is net profit as per PNL. All adjustments of PGBP. Just one extra step. Add remuneration if it is already debited to the PNL. Okay. Now, while computing the book profit, ignore brought forward loss, ignore chapter 6A, but consider UAD, because from 28 to 44, whatever is there, consider that. Brought forward loss and chapter 6A are not considered in 28 to 44. Brought forward losses are covered in 70 to 80, and chapter 6A is covered under 80C to 80U. Okay. Then after that, find out the remuneration. So while computing the book profit, no chapter 6A, no brought forward loss should be adjusted. Okay. And then find out the remuneration. And while computing the total income and tax liability, yes, you can reduce the brought forward loss and you can reduce the chapter 6A to compute your total income under the income tax law. Next one is a clarificatory explanation for certain people. For example, I am a partnership firm and you are a partner and you are an HUF, and HUF is a partner and there is a Karta of HUF who is a representative of the partner. Okay, so HUF is the partner, I am the partnership firm, and the Karta is representing you. Now, if Karta is giving some money out of his own pocket, and I am paying interest to Karta, that cannot be covered in what? That cannot be covered in 40B, because the Karta has given the money out of his personal capacity. The Karta is not giving the money from HUF. It is not the partner's money. It is the member. It is the Karta's money who is not the partner of the firm. So in that case, it will not be covered under 40B. This is what it wants to tell you. Okay. Now, next one is Allahabad High Court judgment, Great City Manufacturing Company. What does it say? Listen carefully, please. There is a firm who is paying some remuneration to the partner of 40 lakh rupees. Now, the AO is saying that you are paying too much remuneration to the firm, to the partner, which is 40 lakh rupees. This is too much. This is much higher than the fair market value of the remuneration. Therefore, I disallow the remuneration under 40A2. Now, the question is, if the remuneration is within the limits of 40B and it is mentioned in the deed also, and the partner is also working partner, can the department disallow the remuneration based on 40A2? Moral of the story, can 40A2 override section 40B? And the answer is no. The law says that 40B will override 40A2, but 40A2 cannot override what? Cannot override 40B. I hope it is clear to all of you, right? Next, What is the treatment of share of profit in the hands of the partner? The treatment of share of profit in the hands of the partner is exempt. It is always exempt under section 10(2)(a). Sir, what if the firm has not paid tax on that? Then also exempt. Suppose the firm has earned 100 lakh rupees, that is fully exempt under section 10. Then also it is exempt in the hands of the partners. The answer is yes. The CBD has issued a circular that the share of profit is always exempt in the hands of the partner, irrespective of whether the firm has paid tax or not. It doesn't matter. What is the treatment of remuneration and interest in the hands of the partners? The treatment of remuneration and interest depends upon if the firm has claimed deduction, then it is taxable as PGBP in the hands of partner. If the firm has not claimed deduction, it is disallowed in the hands of the firm, then it is exempt in the hands of the partners under the income tax law. Okay, I hope it is clear to all of you. Whether remuneration and interest will be allowed to assessee who are covered under presumptive income, that I have told you in the chapter of PGBP also, that if you are following 44AD and 44ADA, then the remuneration and interest will not be allowed to you. But if you are following 44AE, then the remuneration is allowed. This is the amount of great interlinking that we are trying to do over here. Okay, the next is about set off and carry forward of losses. Suppose there were 4 partners in the last year, A, B, C, D, and all of them have incurred a loss of 8 lakh rupees, and all of them are equal partner. Okay, now one of the partner retires in the current year. So how much loss will be lapsed out of it? So how much loss will be lapsed if one of the partners is retired, or if one of the partner is dead? Then how much loss will be lapsed in the hands of the firm? Will entire 8 lakhs be allowed? No. This much loss will be lapsed. What is written over here? You need to find out the share of the retired partner in the brought forward loss. How much is the share of the retired partner in the brought forward loss? It is 2 lakh rupees. Okay. Then you have to find out the share of the retired partner in the current year profit. So whatever is the profit, suppose the profit of the current year is what? Suppose the profit of the current year is 3 lakhs. And therefore say out of 3 lakhs, 75,000 is the share of the retired partner. Okay. Therefore 1.25 lakhs will be what? Lapse. 1.25 lakhs will be lapse out of 8 lakh rupees. Okay, I hope it is clear to all of you. This is how you are supposed to compute how much loss will be lapsed if one of the partner is retiring or if the one of the partner is dead. Okay, this section is not applicable if there is a change in PSR. It is only applicable if a partner dies or if a partner retires. If there is only a change of PSR, you are not going to do all those things. This section is not applicable. Okay, next one is a small case law. If an HUF gives remuneration to Karta or any other member who is a part of the business of the family, whether that remuneration will be allowed or not, the Supreme Court has held in the case of Jugal Kishore Baldev Sahai, yes, if it is paid under a bona fide agreement, there has to be a bona fide agreement between both of them, and it should be in the interest of the business of the family, and it should not be unreasonable and excessive. It should be reasonable and not excessive. Then it will be allowed to the HUF, otherwise it will not be allowed. Okay, next one, political party exemption. Which all incomes of a political party is exempt under section 13A? The following incomes are exempt: HP exempt, CG exempt, IFOS exempt, PGBP not exempt. PGBP is taxable. Voluntary contribution, that is donation, depends. Donation will be exempt subject to some condition. First, the assessee, that is the political party, has to maintain books of accounts, etc. and documents. Okay, that if the donation is greater than, if the contribution is greater than 20,000 rupees per person, then they have to keep the name and the address of the donor. So below 20,000, there is no need to keep the name and the address of the donor. But if it is greater than 20,000, then the donor has to keep the donee has to keep the name of the donor. The political party has to keep the name and address of the donor, and there has to be an audit of the accountant by the accountant. Okay. Further, the due date is for them is 31st October to file the ITR. They have to file the ITR on or before the due date of filing of return. Otherwise, their exemption will be gone. If they want exemption, they have to file the return on time. Further, if they are receiving more than 2,000 rupees from anybody, they have to receive by 4 modes, that is account pay check, account pay draft, ECS or such other electronic mode, and a very controversial way, that is electoral bonds, which is struck down by Supreme Court very recently but not relevant for exams. Supreme Court has said that it is unconstitutional and it will be removed from the income tax law also, but for our exam it is right now applicable, so you all don't remove, but it is unconstitutional, it is wrong. Supreme Court has already said that, but for exam purpose right now it is applicable. Okay, so if you receive more than 2,000 rupees from any person, you have to receive by 4 modes or you have to receive by electoral bonds only. No other way you can receive the money. Okay, now taxation of electoral trust 13B. What is electoral trust? Electoral trust is an intermediary who will receive donation from corporates and will give to the political party. So what is the role of this particular electoral trust? The role of this electoral trust is whatever money they receive, they have to distribute 95% of the aggregate donation to various political party. Suppose in the current year, the electoral trust has received 100 crore rupees. So they have to distribute 95%. If they distributed 95%, entire 100 crore will be exempt. If they distributed even 0.1% less than 95%, entire 100 crore will be taxable. It is as simple as this. There is nothing great to think on it. Okay. Now, suppose if I receive 100 crore in the current year and I distributed 96 crore. So it's okay. Now 4 crore is the balance. Now next year when I receive another 100 crore, so next year I have to distribute 100 plus previous year balance also. So 104 crore ka 95% I have to distribute in the next year. Otherwise it will become taxable. Okay. Be very careful. Only donation is exempt. If I put this money in some bank account and earn some interest out of this or any other income, then that is not exempt. That will be subject to taxable. What is the advantage to the donor? The donor will get deduction under 80 GGC and even under 80 GGB also. Okay. Now let's move on to one last part of this chapter. That is taxation of AOP and BOI, association of person and body of individuals. Now there are two types of AOP, BOI in this world. One, where the shares of the members are known and determinate. Another, where the shares of the members is unknown and indeterminate. We are not aware of the shares of the member. Okay. So these are the two types of AOP, BOI which are there in this world. First, let's talk about the shares of the members are known and determinate. Then what has to be done? In that also you need to see there are various categories in that. Suppose I have an AOP, there are three members A, B, C, and the shares of the members are known and determinate. Now, in that the first case is none of the members have total income greater than basic exemption limit. We are three members. All of our income is less than the basic exemption limit, less than 2.5 lakh. All of our income is less than 2.5 lakh, 3 lakh, whatever is the basic exemption limit. And none of us are a foreign company. None of us are a foreign company. The meaning of this three line is nothing but foreign company only. Because there is no other person in this country who is chargeable at more than MMR. Only foreign companies charge at what? More than MMR. So if all the partners are having income less than basic exemption limit, and all the partners are not foreign company, then AOP will be taxed at individual rates. And the partners have to make a statement of allocation. How they will make a statement of allocation, that I am telling you orally. I will not be able to tell you by writing it on the board, okay? Because that much time is not there in the revision video. How the partners will make the statement of allocation. AOP will pay tax individual rates. Now how the partners will make? All the partners will write the share of income from AOP, the share of remuneration, the share of profit, interest, whatever they have received from AOP BOI, they will write that. Name that as number one. Then the partners will write other incomes. Other incomes they will add, then that point that as number two. Then total both of them. Point number one, point number two. Point number one is share of all the incomes from AOP, and point number two is your other income. Now take your basic tax. Don't include surcharge and cess, okay? Just take your basic tax. Now whatever is the basic tax, from that you are going to get rebate under 86, okay? Now what is the rebate that you are going to get? Whatever is the tax, multiply by. What is point number one? Okay? Divided by whatever is your total income. Okay. So whatever is point number one, divide by, it means in your tax, whatever tax is coming because of this AOP share, that much rebate you are going to get in 86. After that 87 a rebate, and then you have to apply surcharge as whatever is there and compute the tax liability of the partners. Okay. Now, if one or more members have income greater than basic exemption limit, if one or member A, B, C, if one of the members have income greater than 2.5 lakh, then what will happen? Still, none of the members are foreign company. Then the entire income of the AOP will be charged at MMR. And what is MMR? MMR stands for maximum marginal rate, which is 42.744%, 30% plus 37% plus 12%. Plus 4%, sorry, 30 plus 37 plus 4, that is 42.744%. So what about the share of income in the hands of the member? It is exempt in the hands of member, and even MAT will not be chargeable on that share of income. Even minimum alternate tax is exempt in the hands of the members. Now, if one or more member is a foreign company, then what will happen? If one or more member is a foreign company, then we have to do two calculations for the income of the AOP BOI. Whatever is the share of foreign company, on that the higher rate will be applicable, that is foreign company rate 43.68%, 40% plus 5% surcharge, for plus 4% cess, and for other incomes you will be chargeable at MMR, that is 42.744%. Suppose I am an AOP and one of the member is what? There are three members ABC and one of the member is foreign company. All of them are equal partners. So now we are earning 9 lakh rupees. So on foreign company share, that is 1/3 share, 3 lakh rupees, we will be chargeable at 43.68, and on other income, that is another income that is on 6 lakh rupees, will be chargeable at 42.744%. Okay. Now again, it will be exempt in the hands of the what? In the hands of the members. One important disadvantage for an AOP BOI is AOP BOI will not get the deduction of interest and remuneration which is paid to the members, unlike partnership firm. The partnership firm get no deduction under 40B, but for AOP BOI there is a specific disallowance under 40BA which says that any remuneration and interest which is paid to the members will be disallowed under the income tax law. Now what about those kind of AOPs where the share is indeterminate and unknown? Now it is very simple. Here you have to check if any of the member is a foreign company. If none of the member is a foreign company, all are Indians, then the entire income of the AOP will be charged at MMR. And if any one member is also a foreign company, even if one member is a foreign company, then the entire income of the AOP will be chargeable at 43.68. Members' income will be exempt. Even MAT will not be applicable on members' income. Book profit will be reduced by that much income which is received from AOP BOI by the company. Okay, I hope it is clear to all of you. So this is what this small topic is all about. Very, very, very important topic. Especially partnership firm and AOP BOI is very, very important. Okay, so just go through it and then we'll move ahead with the next topic, and that is profit link deduction, MAT AMT. Okay. So let's go ahead with the discussion of the next chapter, that is profit link deduction. In this, there are 4-5 deductions which are available as a profit link deductions. There are two types of deductions which are there in the chapter 6A. One is called as profit link deduction, another is called as payment link deduction. Payment link deduction we will talk later on, like ATC, ATD, etc. Today we will talk about profit link deduction. The very first one is ATIA. Now all these deductions are also called as sunset deductions under the income tax law, because more or less some or the other way all of them are going to be removed in the next few years. Okay. Now the very first deduction over here is of infrastructure facility. If you are engaged in developing, maintaining or operating infrastructure facility from 95 to 2017, then you are eligible for this deduction. So after 2017, as you all might be knowing, infrastructure facility is covered under section 35 AD, and this section is not relevant. If you start your facility after 2017, all those who have started their facility before 2017 will be continued to take the advantage. Okay. Second, you should be engaged in maintaining an industrial park from 97 to 2011. Third is power generation from 93 to 2017, transmission or distribution of power from 93 to 2017, renovation and modernization of existing network from 2004 to 2017, and reconstruction and revival of power generating plant by an Indian company between 2005 November to 31st March 2011. This is the period which you have to follow. Now, obviously, you are not going to remember all these things, not relevant for exams. So remember, how much deduction I will get? 100%. Now, in that also, there is some differences. For infrastructure facility of road, bridge, railway system, highway project, water supply project, for these people, they have an option to select 10 consecutive years out of the 20 years. So out of the first 20 years, they can take they can make their income deductible for the first 10 years, for any of the 10 years out of the first 20 years. And for others, the limit is slightly lesser. It is 10 consecutive AYs out of the first 15 AYs. Okay. Now the second section is ATIAB. In this section, you are going to start with a SEZ. You will develop an SEZ, and between 2005 to 2017, then your income will be 100% deductible in first 10 years out of the first 15 years. Okay. Next, if you start with an industrial undertaking in J&K, industrial means a manufacturing unit in J&K, between 93 to 2012, then you will get 10 years deduction 100%. If you are a cooperative society, then you will get 12 years deduction 100%. Okay. Then if you start with a commercial production of mineral oil, natural gas, then if you start mineral oil between 97 to 2017 and natural gas between 2009 to 2017, 7 years consecutive deduction, 100% deduction will be available to you. Next, if you are engaged in processing, preserving, packing of fruits, vegetable, meat, poultry, marine, dairy, or handle, storage, transport of food grains, then if you do it on or after 1st April 2009, in other case, in case of meat products, poultry or marine products or dairy product, you have to start on or after 1/4/2009. Even today it is available. And in case of other, you have to start on or after 1/4/2001. So you will get 100% deduction for the first 5 years and 25% for the next 5 years. Okay. And in case you are a company, you will get 30% deduction for the next 5 years. So for everybody, 100% for the first 5 years, and next 5 years company will get 30 and others will get 25%. If you start with a manufacturing unit in Himachal Pradesh and Uttaranchal, or if you start with a manufacturing unit in northeastern states, then these two sections are available. In Himachal Pradesh and Uttaranchal, you have to start between 2003 to 2012. In northeastern state, you have to start between 2007 to 2017. Okay. How much deduction? In Himachal Pradesh, first 5 years, 100% deduction. For next 5 years, 25% for company, for company 30%. For other assessees, it is 25%. And in northeastern state, it is flat 100% for 10 years. Okay. You are going to get 100% deduction for the first 10 years directly. Okay. Now, there is one small case law of Praveen Soni, which says that if you get a deduction for 10 years, and if you don't claim the deduction in the initial 2-3 years, say I did not claim the deduction in the first and the second year, I started claiming deduction from the third year, will I be getting the benefit of this section? The answer is yes. It will be allowed to you in the third year also, from the third year also, but only for the remaining years. So from third year up to 10th year, you can claim You cannot claim 10 years from third year. Okay. From third year, you will get the benefit for remaining number of years. I hope it is clear to all of you. Next one is ATISC, which is for eligible startup. Now, there are a lot of conditions over here for eligible startup. First of all, you should be a company or LLP. You should not be in any other form. Secondly, your business should be incorporated. Your company should be incorporated between 1st April 2016 to 31st March 2024. That is before 1st April 2024. Your turnover in any year should not exceed 100 crore rupees. Okay. You should be holding a certificate from the central government interministerial board of certificate that you are an eligible startup. Okay. So for becoming a startup, you have to obtain a certificate from central government. Next, your business should not be formed by splitting up or reconstruction of an already existing business. It means your business should be an absolutely new business, just like 3580. Your business should not have a second-hand plant and machinery. Second-hand plant and machinery not allowed, but second-hand plant and machinery up to 20% of total value is allowed, and imported second-hand plant and machinery is also allowed if depreciation is not claimed on that. If all these conditions are fulfilled, you will get 100% deduction out of your first 10 years. You can claim 3 years, 100% deduction, 3 consecutive years. 3 consecutive years, you can claim 100% deduction. You have to submit ROI. You have to also do audit of your books of accounts if you want to claim the deduction. Okay. The next section is ATIBA, which is eligible for certain eligible housing projects. If you are a developer, if you are a builder, this section is applicable for you. This section is applicable to all kind of businesses, individual, HUF, firm, AOP, BOI, company, etc., etc., etc. Everybody is covered over here. You have to develop a predominantly residential unit. You need to make a project where predominantly it is for residential purpose. Predominantly for residential purpose means the commercial purpose should not be more than 3%. Maximum 97% has to be for residential purpose. Your project should be approved between 1st June 2016 to 31st March 2022, and after it is approved, you should complete the project in 5 years. In 5 years, you should complete it. You should obtain a certificate from a competent authority that your project is completed. And in that project, if you have given a house to a particular person, say for to me, then you cannot give another house to the same person. You cannot give another house to the spouse of the same person. You cannot give another house to the minor child also of the same person. So if I get one house, I will not get another house in that same project. My wife will not get another house in the same project. My minor child also will not get another house in the same project. Now, what should be the size of the building? What should be the size of the land? What should be the size of the house? And what should be the height of the building? So all of them are given over here. For that, the government has divided all the places into 2 categories. If you are staying in Chennai, Delhi, NCR, Kolkata, Bengaluru, Maharashtra, Mumbai or Hyderabad, then the criteria is different. If you are staying in any other part of this country apart from these 6 cities, then the criteria is different. First of all, what should be the plot of the land? How big should be the plot of the land? In these 6 cities, the plot of the land should not be less than 1000 square meter. It means it has to be at least 1000 square meter. In other cities, it should be at least 2000 square meter. Then what should be the carpet area of the house? In these 6 cities, the carpet area should be maximum 60 square meter. In other states, in other cities, it should be maximum 90 square meter. What should be the minimum utilization of floor area ratio? Floor area ratio means if the government is allowed you 100 meter building, how much you should at least utilize? So in these 6 cities, you should not be utilizing less than 90%. It means you have to utilize at least 90%. If the government tells you 100 meter, then you should make at least 90 meter building. In other cities, you should make at least 80% building. Okay. You have to maintain separate books of accounts. Plus, very important, the stamp duty value of each residential unit should not be more than 45 lakh rupees. It should not be more than maximum stamp duty value should be 45 lakh rupees for the houses. Okay. Next. Suppose the AO disallows some income, then whether that disallowed portion will also be allowed as deduction under Chapter 6 under ATIBA? The answer is yes. The Bombay High Court in the case of Sunil Vishwambharnath Tiwari has held that if the assessing officer disallows something under 40A1A for non-deduction of TDS, etc., then that portion will also be allowed as deduction under what? Under ATIBA. 100% deduction will be allowed of your profits if you fulfill all these conditions, and if you don't complete the project within 5 years, whatever deduction you have claimed earlier will be deemed to be what? Your business income. Okay. I hope it is clear to all of you. Now, this project was for buying the project. Now, the government has said that we will also prescribe what? Something for affordable renting house. If you make a building and rent to people at affordable rent to people, don't sell to people, rent to people at affordable rent, then that will also be subject to deduction. But government will notify an entire scheme for this. Unfortunately, they have not notified anything so far, so we cannot talk about this much as of now. Okay. Now, the next and the last profit link deduction over here is the profit link deduction of ATPA producer company. If you are a producer company which is covered under section 581 of Companies Act 1956, And if you are engaged in the following activities, these activities are more or less same as cooperative society only. That is marketing of agricultural produce grown by members, purchase of agricultural produce, implement seeds, livestock, etc., supplying to members, processing of agricultural produce of its members. Same, all 3 points are there in ATP also. If you are engaged in these 3 points, and if you are what, a producer company, then 100% of your profits will be what, deductible over here. The condition is your turnover should be less than 100 crore rupees. And this is available for these 5 years, AY 1922, AY 24-25. Okay, I hope it is clear to all of you. Let's move ahead with the next topic, and that is minimum alternate tax, a very important topic for us, which is 115 JB. A company is liable for 115 JB, and the company has to make 2 calculations. One, tax as per the normal provision, one tax as per 115 JB, whichever is higher, company is liable to pay tax as per that. Okay, so a company is liable to pay 115 JB. Every company in this country is liable to pay 115 JB, except few companies which are exempted, which we'll talk in some time. Okay, so you have to make 2 calculations: normal provision, MAT, whichever is higher. In normal provision, you will compute tax as per, you will compute income as per 5 heads of income, chapter 6A. In MAT, you will compute income as per the book profit. And how to compute book profit, that is what we are going to learn in this particular chapter. Along with that, we will also learn the relevant effect under the normal provision. Is MAT applicable to all companies? MAT is applicable to all companies who are covered under Companies Act, and all those companies who are not even covered in Companies Act, like insurance company, banking company, electricity company. These companies are not covered in Companies Act. For them also MAT is applicable, MAT is applicable, MAT is applicable. Okay, now to compute book profit, we need to make P&L. And how should we make the P&L? P&L should be the same as you keep in front of the shareholders in the AGM. Whatever P&L you have kept in front of the shareholders in the AGM, that same P&L will be used to compute what? Book profit under the income tax law. Now suppose some foreign company is there who is following some different financial year. They are following calendar year as their financial year, and we are following accounting year as our previous year as financial year. Okay, April to March. They are following Jan to December. Now what that foreign company will do to compute the book profit? That foreign company has to readjust its P&L as per the financial year of India. That is April to March. They have to redraft their P&L and they have to compute the book profit. Okay, now how to compute the book profit? That is given under explanation 1 to 115 JB. The MAT is 15% of the book profit. Okay, so how to compute the book profit? Book profit is nothing but net profit as per P&L. And how will you make the P&L? You will make the P&L as per what? As per the accounting policies, accounting standard, which you follow to lay down in front of the shareholders in the AGM. And then you have to make few additions, you have to make few deletions, and that will give you book profit. Okay, now what are the few additions and few deletions? We will talk about all of them one by one, and we will also see the relevant effect, the ripple effect in the normal provisions of the income tax law, because that is also important for you. Sometimes questions based on both of them can also come in the examination. The very first thing is income tax surcharge and cess. It will be added back in MAT. It will be added back in the normal provision also. It is same. In the MAT also it is added back. It is written in explanation 1 to 115 JB, and in normal provision it is added back as per section 40 clauses sub clause 2. Okay. What about interest on income tax? It is added in 115 JB. It is added in normal provision also. Okay. What about penalty under income tax law? Now, penalty under income tax law is not added in MAT. It is not disallowed in MAT, but it is added in the normal provision because it is penal in nature. Here the difference starts to come. Okay. Next one, wealth tax. It is not added in MAT, but it is added in the normal provision because it is specifically mentioned as a specific disallowance. Now, DDT is no more relevant, so we are not talking much about DDT. Transfer to reserve. It is added in the MAT, and it is also added in the normal provision except one reserve, that is transfer to special reserve, which is covered under section 36(1)(8). That will not be added. Okay, I hope it is clear to all of you. STT is not added in MAT, and in normal provision it is allowed if it is a PGBP income. If you are a dealer in security, it is allowed, otherwise it is not allowed. Okay, now provision for unascertain liability. It is added in MAT, and it is also added in the normal provision. In the normal provision, why? Because provision for unascertain liability is specifically added over here, and in normal provision also. And in normal provision though, even if the provision is as per actuary, that is also added back. But if in the MAT, if the provision is as per actuary, that is not added back, because then you cannot call that as what? As an unascertain liability. Then it is an ascertained liability. Okay, ascertained liabilities are not added back in MAT. Ascertained liabilities are not added back in MAT. Only unascertained liabilities will be added back in MAT. Now some common points. Provision for loss of subsidiary will be added in both. Dividend paid will be added in both. Now next few things, very important. There is a P&L in front of you, and on the debit side of P&L, there is an expense which is related to section 10 income, and on the credit side of P&L, there is an income which is related to section 10 income. Then what will you do under the normal provision? Under the normal provision, any expense which you incur to unexempt income is added back, and that exempt income is also reduced from your profit, because on that you will not pay tax. The same treatment you are going to give under what? Under the income tax law, MAT provision also. Same thing. On the debit side, if there is an expense which is incurred for an earning exempt income, add back. And on the credit side, if there is some income which is exempt under section 10, reduce from the book profit. We don't want the impact of that in our book profit. Okay. So section 10 expense will be added back. Section 10 income will be reduced under normal provision as well as under the MAT provision. Sir, what about LTCG? If there is LTCG in your P&L account, you will reduce from the P&L account and show under PGBP as per the normal provision. Under MAT, ignore. Let it be part of book profit. Let it bear the brunt of the income tax. That is 15% MAT. Okay. STCG. What about STCG? Same treatment for STCG also. Under the normal provision, you will add less from the PGBP and show under what? Capital gains. But under MAT, you will ignore it. Let it be part of book profit. Now coming to the most important point. What about the profit link deduction? 10AA, ATIA, ATIB, all these profit link deductions which we have learned or which we are going to learn later on. What is the impact of that? Under the normal provision, you will not do anything till GTI. And from GTI, you will reduce them. From GTI, you will reduce chapter 6A and you will get the deduction. So no need to pay tax under the normal provision. But under MAT, if you find all these profit link deduction, ignore them. Let it be part of book profit. The very reason why MAT has come is to take tax from these people. Let it be part of book profit and let people bear the brunt of this tax on this particular income. I hope it is clear to all of you. What about the share of profit from partnership firm? As I have told you, all section 10 incomes are not subject to MAT. Therefore, reduced from MAT and also in normal provision it is exempt. Share of profit from AOP BOI. Do you remember that is also exempt under section 86? So under normal provision it is exempt under 86 because the AOP has already paid tax at MMR. So it is exempt in the hands of the member. Share of income from the AOP is exempt in the hands of the member. So because AOP is already paying very high tax, so member will be exempt. So member will be exempt under MAT also. Under MAT also member is not liable to pay any kind of tax under the income tax law. Okay. Now for foreign companies, there are some relaxations which I am going to tell you one by one. Listen carefully. If a foreign company is earning the following incomes, listen carefully. If a foreign company is earning capital gain on security, or if it is earning interest, or if it is earning dividend, or if it is earning royalty, or if it is earning fees for technical surveys. So if it is earning capital gain on securities, not all capital gains, okay? Or if it is earning interest, dividend, royalty, fees from technical services, then under the normal provision, they will pay tax as per the normal rates. But under the MAT, there are two options. If their MAT rate is 15% and if the normal rate is less than 15%, then MAT will not be applicable. If the normal rate is less than 15%, MAT will not be applicable. Suppose if the normal rate is 10%, MAT will not be applicable. But if the normal rate is 20%, MAT will be applicable to these people as per the income tax law. For more understanding, we will do all these things in the chapter of non-resident taxation. Don't worry about it. Okay. Let's talk about the impact of depreciation. Sir, what is the impact of depreciation? Listen, under the normal provision, what do? You add depreciation to P&L and then you reduce from what? Under section 32 depreciation, you reduce the income tax wala depreciation, right? But in MAT, what you will do? You will add depreciation as per P&L and you will reduce depreciation which is other than revaluation portion. Suppose 100 rupees is the cost of the asset. 10% is the rate of depreciation. Now 200 rupees you have revalued. So 300 rupees is the value of the asset. So how much depreciation will be there in the P&L? 10% of 300 will come to 30 rupees. So 30 rupees you will add back and then you will reduce other than revaluation. How much is other than revaluation? Other than revaluation is only 10 rupees. So 10 rupees you will reduce under the income tax law. I hope it is clear to all of you. Okay. Now deferred tax, you will add less under both normal provision also and under MAT also. Okay. Now provision for diminution in the value of asset. Example of this can be considered as provision for bad debts. Under normal provision also provision for bad debts is added back except for NBFCs and banks to whom certain percentage is allowed as deduction. But under MAT, there is nothing like that. It will be always disallowed. Provision for bad debts is always disallowed under MAT. Okay. The next one is royalty income under 115 BBF. For that, we need to understand what is royalty income under 115 BBF. If you want to know, you have to come to the next page to understand what is royalty under 115 BBF. 115 BBF is a special tax rates to certain resident people. If you are a resident and if you have developed a patent, if you have developed some product and if you have patented that India, then and if you are a true and the first inventor of that product, then the government gives you an option. This section is an optional section. The government gives you an option that you have to pay tax at 10% of your revenue. Whatever is your revenue, pay 10% tax on that. You are not going to get any deduction of any expense and all. Expense and all will not be allowed to you as a deduction. And how can I opt for this section? You can opt for this section on or before the due date of filing of return. Okay. And once you opt this section, very dangerous point is, once you opt this section, you have to follow this section for the next 5 years. And if you do not follow the section for the next 5 years, Then for the another next 5 years, we will not allow you to come back to this section. It is just like 44AD. I hope you remember that. And even in 44AD, you can go check back. Go and check back in 44AD. Even there I have written in the bracket, similar provision is there in 115 BBF. This is the level of interlinking that we have done in our books. Okay. So this is the level of interlinking which is required at CA final to crack a dangerous paper like direct tax. Okay. So now this section is applicable to resident. If you are a true and first inventor, you have developed a patent, then your revenue ka 10% will be your tax, will be your income. Okay. That much will be your profit, but you will not get the deduction of any expense. If you want to come for this section, you can come, you can opt for this. Okay. You can opt for this section before the due date. Once you opt, you have to follow for 5 years. Okay. One very important condition over here is, one of the important condition of this section is 75% of the R&D expense has to be done in India. Where? In India. And one of the biggest disadvantage of this section is, if you come for this section 115 BBF, then no MAT will be applicable. Therefore, if there is any revenue in your P&L, it will be reduced from the book profit. And if there is an expense in the P&L with respect to this income, it will be added to the book profit. This is what this provision wants to tell us. If you follow a royalty income under 115 BBF, MAT will not be applicable. Add less the income and the expenses, and normal provision, it will be taxable at 10%. Okay. Next one, point number 17. Let's come to the credit side of P&L. Suppose if I transfer to reserve, then I have to add it back. If I transfer back from reserve to my P&L, then what will I do? I will reduce it from my P&L as per the normal provision. But what as per the MAT? As per the MAT, it is allowed to reduce only if it was added earlier. Okay. If it was added earlier, then only you can reduce. For example, in your P&L account, there is a profit of 100 rupees. You have transferred 20 rupees to your reserves account. So you will add 20 rupees, right? And later on, if you transfer that 20 rupees from reserves to again P&L account, so you can reduce it. So because it was added earlier, the government is allowing you to reduce it from the P&L account. But if it was not added earlier, the government will not allow you to reduce the profit from the what? The reserve from the P&L account. It will be part of that. So you have to check very carefully in the question what is written. If the question is writing, amount withdrawn from reserve credited to P&L, the book profit of earlier was increased by such reserve, then you reduce. The book profit of earlier year was not increased by such reserve, then don't reduce. Under the MAT, it cannot be reduced. Under the normal provision, you can reduce it. No issue. Okay. Now, what is the treatment of amount withdrawn from revaluation reserve? For this, I have to take one example. Suppose you have bought an asset of 100 rupees. Okay. Now, after that, you have revalued the asset with 200 rupees. So, therefore, this is your revaluation. Okay. Now, the depreciation in the P&L account is how much? It is 30 rupees. Okay. How much? 30 rupees. How it came? 10% of 300 rupees. Now, what is the revaluation reserve in the balance sheet? Revaluation reserve in the balance sheet is 200 rupees. Okay. Because I have revalued by 200 rupees. Okay. Now, if I transfer from here some amount to my P&L account credit side, suppose 50 rupees I have credited to P&L. Okay. Now, how much can I reduce from here? You can reduce only to the extent of depreciation on revaluation portion. Now, what is the depreciation on revaluation portion? This is my revaluation portion, and the depreciation on revaluation portion will be 10% of 200, that is 20 rupees. I can only reduce to the extent of 20 rupees. So, if I withdraw the money from revaluation reserve and credit to the P&L, I can reduce from P&L, but only to the extent of depreciation on revaluation. I cannot reduce more than that. Okay. I hope it is clear to all of you. So, if I credit 50 rupees, I can reduce only 20. But if I credit 10 rupees, then I can reduce entire 10 rupees. I hope it is clear to all of you. Next one, what is the treatment of losses and UAD? Under the normal provision, you can reduce both. Okay. You can reduce loss also. You can reduce UAD also from your PGBP income. But under MAT, you have to choose one of them, lower of the two. That is, lower of the two will be allowed as deduction. But in two cases, you will be allowed to set off both the cases. That is, in two cases, you will be allowed to set off both loss also, UAD also as per the books of account. And this loss is as per books of accounts. This is not your taxation loss. Taxation loss is here and books of accounts loss is here. So this is very separate as compared to what is there in your taxation law. Okay. Now both shall be allowed in two cases. If your case falls under insolvency and bankruptcy code, if you have gone for insolvency and bankruptcy code, you will be allowed both. And if you are coming under section 79 case, which I'll be talking later on in the chapter of section 79, set off and carry forward, then also you can set off both. Okay. Sick company. A sick company will generally not pay tax under the normal provision. Under MAT also, the government says that till the time the net worth does not crosses the accumulated losses, you are not liable to pay tax. So the day when your net worth will cross your accumulated losses, it means your net worth is more, your loss is less. From that year onwards, MAT will be applicable. Now, certain general provisions of what? Income tax law, that is PGBP. GST not paid will be disallowed under normal provision. But under MAT, there is no concept of disallowance of GST not paid. Amount paid in cash in excess of 10,000 rupees. It will be disallowed disallowed under the normal provision. But in MAT, there is no provision to disallow such items. Penalty which is compensatory in nature. The compensatory penalty is allowed under the normal provision also. Compensatory penalty is allowed under the MAT also. Okay. The penal penalty is not allowed under normal provision. In MAT, even penal penalty is allowed. Remember, in MAT, even penal penalty is allowed. Check here. Penalty on income tax is a penal penalty, but that is allowed under MAT. There is no harm in claiming deduction of that under MAT. TDS not deducted. Under MAT, it is allowed. Under normal provision, it is not allowed. Okay. Equalization levy not paid. Under MAT, it is allowed. Under normal provision, it is what? It is disallowed. Okay. Now, some relaxation. As I've told you at the beginning of MAT, for some companies, MAT is not applicable. If you are a life insurance company and if you follow, if you come under section 115B, then MAT 115B is a special section for life insurance companies where you have to pay tax at the rate of 12.5%. So, for these companies, MAT is not applicable. Or if you follow alternative regime under 115B, AA, 115BAB, then also MAT is not applicable for you. For that, we will see in the chapter of alternative tax regime. Don't worry about it. Okay. Now, let's talk about MAT credit. What is MAT credit? MAT credit means when your tax paid under the MAT, suppose it is 10 crore and the tax paid under the normal provision, suppose it is 4 crore, then the difference between the two, that is 4 crore, will be called as MAT credit. So, if your tax under MAT is more than the tax under the normal provision, it will be called as MAT credit. So, when it can be allowed? When can I use this credit? When your tax under the normal provision is say 10 crore and the tax payable under the MAT is 8 crore. So, to pay this 10 crore, when your normal is greater than MAT, you can use the credit. Okay. Now, how much credit I can use? Can I directly use 4 crore to pay 10 crore? No. You can only use to the extent of the difference of 10 crore to 8 crore. That you can use only to the extent of how much? Only to the extent of 2 crore you can use, and 2 crore and remaining 2 crore you can what? Out of this carry forward. Okay. So, when your MAT is more, normal is less, it is MAT credit. When your normal is more, MAT is less, you can use the credit, but not use completely. Only to the extent of difference between the normal provision tax and the MAT provision tax. For how many years it is carried forward? It is carried forward for a period of how many years? It is carried forward for a period of 15 years. Okay. I hope it is clear to all of you. Now, there are some small case laws which I would like to address you all. First one, very important Supreme Court judgment, Apollo Tyres Limited, which says that if the assessee has made a P&L account, the AO cannot change the P&L account. AO does not have the power to change the P&L account, which is already certified by chartered accountant, accepted by shareholders, and also accepted by ROC. Therefore, AO has limited power to only make certain additions and deletions which are mentioned under explanation 1 to section 115JB. He cannot change your P&L account. Okay. Next one, Metal Chromium Platter Private Limited. Assessee has sold some land, and to save the capital gains on that land, assessee has invested some money in 54EC bonds. So whether MAT will be applicable on that 54EC bond, the cohort said that no, don't take that much profit which is invested in 54EC bonds for the purpose of computing MAT. Otherwise, people will not invest only, because if you will start to charge capital gains on that portion under the MAT provisions, then people will not invest in NHAI bond, RECL bonds, and therefore the investment will go down in these sectors. Therefore, allow. The government has allowed that particular thing. Okay. Rolta India, whether an assessee who is paying MAT, are they liable to pay interest under 234BC? Definitely. Why not? All the provisions of the income tax law are applicable to MAT people. All those who are following the provisions of MAT, they are liable to pay tax under 234B and 234C they are liable to pay, interest under 234B and 234C of the income tax law. Okay. Now, last few things, is foreign company liable for MAT? Foreign company is also liable for MAT, but in some cases, foreign company is not liable to MAT. Which are those cases? First case, foreign company is a resident of a country with which India has a DTAA agreement, and that foreign company does not have a permanent establishment in India. So, foreign company is of a country with which India has a DTAA, but that company does not have what? A permanent establishment in India. So, in that case, MAT is not applicable. What about the country with which India does not have DTAA? The country with which India does not have DTAA, there is no DTAA, and the foreign company is not required to take registration under any law. No registration is required under any law. Then also MAT is not applicable on foreign company. I hope it is clear to all of you. So if DTAA is there, then the foreign company should not have a P. If DTAA is not there, then the foreign company should not be having any registration under any law in India. Then MAT is not applicable to these two types of foreign companies. Okay. Next. What is the MAT rate for an IFSC unit? If you are having a unit in IFSC, that is International Financial Service Center, which is in Gujarat, and if your income is derived solely from convertible foreign exchange, then your MAT rate will be 9% instead of 15%. Okay, you will be liable for 9% income tax under MAT instead of 15% income tax. Now, every person who is liable for MAT is supposed to get a report furnished from a chartered accountant. That is Form 29B, certifying that the book profit has been computed as per 115JB, and it has to be done on or before the tax audit due date. That is 1 month prior to the due date of filing of return. It has to be done. Okay. And last but not least, I have told you earlier also, if you are doing a life insurance business, then the 115B is applicable, and in that your income will be taxable at 12.5%, and no MAT will be applicable. And for non-life insurance business people, Rule 5 of first schedule of the income tax law has to be followed, and you have to follow the Insurance Regulatory Development Act and Insurance Act 1938 to make the P&L, and accordingly you have to follow the income tax provision also to compute the income of those people. Okay, not very important for exam, at least this insurance part. Okay, now let's move on to the next part, that is alternate minimum tax. Sir, what is alternate minimum tax? See, MAT came for company, so alternate minimum tax came for other than companies. Okay, so 115JC alternate minimum tax is not applicable to companies, it is applicable to individual, HUF, firm, AOP, BOI, LLP, etc., etc. For these people also, they have to compute two tax in some circumstances. First, tax as per the normal provision, then tax as per the adjusted total income 18.5%. So they have to compute 18.5% of the adjusted total income, whichever is higher. Normal provision, everybody knows how to do, 5 heads of income, etc., etc. Now, how to compute adjusted total income? Adjusted total income is nothing but total income as per the normal provision plus 3 addition and 1 deletion. 3 items you have to add, 1 items you have to reduce. What are the 3 items that we have to add? The very first thing that we have to add, all the profit link deductions, not payment link deduction, except ATP. On cooperative society, ATP, AMT is not applicable. Okay, except ATP, all profit link deductions you will add back. Then 10AA you will add back. And then for 35AD you have to do 2 things. 35AD you have to add first, and then you have to reduce your normal and additional depreciation, if any, on the 35AD asset. Okay, so suppose you have claimed a deduction of 100 crore on building, so you will add 100 crore and then you will reduce 10% on the building as the depreciation, as the reduction over here. Okay, that much deduction government is giving you. So all profit link deductions you will add back, and in 35AD investment link deduction you will add back investment link deduction, and then you will reduce depreciation. After that, whatever amount will come, that will be called as adjusted total income. Okay, now this adjusted total income is only 15%. For what? For cooperative society. For cooperative society it is 15%. For normal people it is, for normal assessees it is what? It is 18.5%. So now you will say, sir, just now you said that cooperative society is not liable for ATP, for AMT. I did not say cooperative society is not liable for AMT. There can be 2 types of cooperative society. One cooperative society who is eligible for ATP. If the cooperative society is eligible for ATP, then AMT is not applicable. But if the cooperative society is not eligible for AMT, then definitely it is applicable for what? It is liable for the provisions of AMT. Okay, so you need to check whether the cooperative society is liable for AMT or it is not liable for AMT. You have to check according to that. So if a cooperative society is eligible for ATP, then no AMT. If not eligible for ATP, then AMT is applicable, and then tax rate will be 15%. Now, for everyone, if the unit is located in IFSC and if the consideration is payable in foreign currency, then just like MAT, here also 9% will be chargeable to you. Okay, 9% AMT will be chargeable to you. Now, you will not add back the payment link deduction. You will only add back the profit link deduction. Payment link deductions will not be added back. Be very careful. Okay. Second, AMT is not payable by small individual, HUF, AOP, BOI, artificial juridical person. If you are an individual, HUF, AOP, BOI, artificial juridical person, and if your adjusted total income after adjusting those 4 items, it is up to 20 lakh rupees, it is not exceeding 20 lakh rupees, then AMT is not applicable. It means for individual, HUF, etc., AMT is applicable only if the adjusted total income is greater than 20 lakh rupees. But for partnership firm and LLP, there is no limit like that. For partnership firm and LLP, even if it is less than 20 lakhs, AMT is applicable for them. Be very careful. Okay. Now, just like MAT, here also same AMT credit is there for 15 years. What is AMT credit? When your AMT is more than normal, it is AMT credit. When can I use? When your normal is more than AMT, you can use it. How can you use? You can use it to the extent of the difference of the two. There is no harm in that. Okay. Now, rest all provisions are same only like MAT. There is nothing great as such. Okay. Now, for your examination, always keep this as an int. If there is a question on partnership firm or LLP or AOP BOI, in short, if there is a question on companies other than companies, always search for AMT implication. And when AMT will be applicable, if the question has either ATIA, ATIB, etc., or a question has 10AA, question has 35AD. If the question has these 3 types of deduction, 100% AMT implication will be there under the income tax law. Now, AMT is not applicable to individuals who follow new regime. and to even partnership, to even cooperative societies who follow new regime. So individuals follow new regime in 115 BAC and cooperative societies follow new regime in 115 BAD and BAE. So all those who follow new regimes, for them AMT is not applicable. And last but not least, under AMT also you have to get a certificate from a chartered accountant in form 29C certifying that the adjusted total income is computed as per the provision of this chapter, and you have to submit that report by the due date of tax audit. Okay, that is 1 month prior to the due date of filing of return. I hope it is clear to all of you. Now let's move on towards the next topic, which is a big one, and that is the chapter of penalty. Now in this, there are a lot of penalties that we are going to see one by one. The biggest one out of all is to section 270A, which talks about the penalty for underreporting and misreporting of income, where there can be a penalty of 50% or 200% of your tax payable. Okay, so now let us talk about the first penalty, that is the biggest one out of all. Then we'll talk about the other penalties also which are there in this chapter. The very first thing is, if the penalty, who can impose the penalty under 270A? The penalty can be imposed by AO. Who can impose? AO can impose penalty. Now even Joint Commission Appeal can impose penalty, CIT can impose penalty, and even CIT can impose penalty. Now first thing, the ITAT cannot impose penalty, and if the department wants to impose penalty, they have to issue a show cause notice. Okay, and when they have to issue the show cause notice, they have to issue the show cause notice before completion of their proceeding. Suppose if the AO is doing assessment proceeding, so he has to issue show cause notice before what? Before completing the assessment proceeding. Or if the JC wants to initiate penalty proceeding, then he has to issue show cause notice before completion of the appeal proceedings. Okay, so you have to, the respective authority has to issue notice, show cause notice before completing the respective assessment, appeal or revision proceedings. Okay, now there is a Supreme Court judgment over here of Shadiram Balmukund which says that penalty can impose by only those person who has found the escaped income. Suppose if AO has found the escaped income, then AO can impose penalty. On AO's escaped income, CIT cannot impose penalty. On CIT's escaped income, AO cannot impose penalty. Whoever has found the escaped income, that person will impose the penalty under the income tax law. Okay, now the penalty is also a proceeding. Yes, penalty is also a proceeding like assessment, and therefore a separate order will be passed, and if you are not happy with the order, you can file an appeal against the penalty order. Against the AO's penalty order, you can file an appeal to CIT appeal, and against the CIT appeals penalty order and CIT's penalty order, you can file an appeal to what? You can file an appeal to ITAT. Okay, now how to compute the penalty? That is the most important part and very important part for your examination. A lot of question has been asked on this particular issue. For that, we need to compute always three things. First of all, we need to find out the underreported income. How much income is underreported by the SSE? Then we have to compute what will be the tax on that underreported income, and then on that tax amount we have to impose 50% penalty or 200% penalty in some cases. Okay, when 50%, when 200%, that I will tell you in some time. So first of all, our target right now is to compute two things. First, compute underreported income, and then compute tax on underreported income. Now there are a lot of circumstances over here. Suppose the SSE has filed the return and his assessment is done for the first time, that is his regular assessment is done. Then how the penalty will be computed? First of all, we need to see the income assessed as per the AO has to be greater than the income determined under the processing of return. Okay, under 143(1). Suppose income assessed is 15 lakh, and if the income was processed at 10 lakh rupees, then the difference between the two, that is income assessed 15 lakhs minus income processed 10 lakhs, the difference between the two, that is 5 lakh, will be called as underreported income. Okay, now how will you compute tax on underreported income? Don't make a mistake of directly computing tax on 5 lakh rupees. If you directly compute tax on 5 lakh rupees, you will make a big blunder. That is not allowed. You have to compute tax on something plus something, then you have to reduce tax on something. Now what is something plus something? You have to compute tax on underreported income. How much is underreported income? 5 lakhs plus tax on processed income 15 lakhs. So first you will compute tax on 15 lakhs, and then you will reduce tax on what? Tax on 10 lakhs. So first compute tax on 15 lakhs, entire 15 lakhs, and then reduce tax on what? 10 lakh rupees. Whatever amount will come, that will be tax on underreported income, and on that amount you will apply 50% or 200%. When 50%, when 200%, that I will say you in a while. Now let's talk about those people who do not file the return. This was for people who file the return and whose assessment is done for the first time. All those who people do not file the return, what will be the underreported income for them? For them, whatever the AO has assessed under 144, that is, suppose AO has assessed 10 lakh rupees under 144, you have to compare that with the basic exemption limit. Suppose the basic exemption limit of the SSE is 2.5 lakhs or 3 lakhs or 5 lakhs as the case may be. Okay, so the difference between the two, that is 7 lakh rupees, will be called as what? Underreported income. Okay, this is for individual. For companies though, the basic exemption limit is 0. So for company, the underreported income will always be what? Will always be 10 lakh rupees. So for individuals and HUF, the amount of income assessed, that is 10 lakh minus the basic exemption limit, that is 3 lakh, 5 lakh, 2.5 lakh, whatever it is. Say in our case it is 3 lakh. So the differential amount will be 7 lakh. 7 lakh will be underreported income. Okay. And for other than individual HUF, that is for company, firm, LLP, directly 10 lakh rupees will be called as what? Underreported income. Now how to compute tax? Again, don't make a mistake of directly computing tax on 10 lakh rupees. For companies, you will compute tax directly on 10 lakhs. Directly on 10 lakhs compute tax, because for company entire income is escaped only. Directly 10 lakhs you compute the tax, and then on that penalty will be imposed. But for other than company, don't make a mistake of computing tax on 7 lakhs. You will compute tax on underreported income, that is 7 lakhs plus 3 lakhs, that is you will compute tax on 10 lakh rupees. If you directly compute tax on 7 lakh now, then you will again give an exemption of 3 lakh rupees to assessee from 7 lakh rupees, which is not correct, because 7 lakh rupees is over and above 3 lakh rupees. Okay. Therefore, you have to add 7 lakh plus basic exemption limit on 10 lakh rupees, directly compute the tax. Okay. Now, what is the case of reassessment? In case of reassessment, it's very simple. Whatever income is reassessed under 147, say 20 lakh is reassessed, you have to compare that with how much it was assessed earlier. In the previous assessment, it was earlier how much? So, in the previous assessment, it was 12 lakh rupees. So, compared to 20 lakhs with the previously assessed, so 8 lakh rupees will be your underreported income. So, 20 lakhs minus previously assessed, it is how much? It is 12 lakhs. So, 8 lakhs will be previously assessed. So, how will you compute tax? Again, don't compute tax directly on 8 lakh rupees. Tax will be underreported income, that is 8 lakh, plus income in the preceding order. Preceding order, how much was the income? It was 12 lakh rupees. Therefore, first compute tax on 20 lakhs and then compute tax on again 12 lakhs and then take the difference between the two. That will be your tax on underreported income, and you will pay tax on that much amount. Okay. Now, next one is a very dangerous part. It is talking about 115 JB. For 115 JB, I have to take some example. Suppose the total income as per the normal provision, it is 80 lakhs. And the book profit as per normal as per 115 JB, it is 200 lakhs. That is 2 crore. Now, suppose the AO has added 30 lakhs over here and AO has added 10 lakhs over here. Okay. So, this has become 110 lakhs and this has become 210 lakhs. Now, how to compute? How to compute the underreported income and tax on underreported income over here? So, for that, the government has given a formula: A minus B plus C minus D. What is A? What is B? A and B is for normal provision. What is C? What is D? C and D is for 115 JB. So, what is A? Let's read. A is total income assessed as per the general provision. How much is the total income assessed as per general provision? 110 rupees. So, A will come to 110 lakhs. Okay. What is B? B is total income assessed as per general provision minus underreported income. What is the total income assessed as per general provision? Just now I have written above only. B starts with A only. That is 110 lakhs. And what is the escaped income over here? What is the underreported income? 30 lakhs. Therefore, B will come to 80 lakh rupees. Therefore, A minus B will come to how much? 110 minus 80. Therefore, A minus B will come to how much? It is 30 lakh rupees. And then you have to compute tax on 30 lakh rupees in the manner in which you have computed in the first box. Tax on underreported income plus something minus tax on something. Okay. This is how you are going to compute. For 115 JB also, you are going to follow the same rule only. Same rule only you are going to follow in 115 JB also. Okay. Total income assessed as per 115 JB, 210 lakhs. 210 lakhs. And here 210 lakhs minus underreported income is 10 lakhs. Okay. So, this will come to 200 lakhs. And the difference between C minus D will come to how much? It will come to 10 lakh rupees. Okay. This is how you are going to compute C minus D. One last thing that I would like to say over here is, if this 30 lakhs and this 10 lakhs has some common additions, there might be some additions which are common in nature. Suppose 4 lakh is common. So, in that case, the government says that you have to ignore that common addition in D and you have to consider that in B. The government is very intelligent. They want to take that in 30% tax bracket and not in 15% tax bracket. So, if there is some common addition in both, then ignore in D and consider in what? Consider in B. Okay. Now, this one is also same. I'm not wasting my time unnecessarily to speak about this case once again. Now, next one is very important case for examination. Math wala case they have not asked any time so far in the examination till now. Okay. Maybe in the new course they might test you with the portion with the probability is that the math provision might be tested in the new course. Okay. The next one is there is a return which is a loss. Okay. In the return ROI you are showing a loss of 10 lakh rupees. And during the assessment your loss is what? Reduced to 2 lakh rupees. So, if there is a reduction of loss, or if there is a reduction of loss to a such an extent that your loss becomes income, the loss becomes what? Income. Then it is very simple. Whatever is the loss assessed, compare with whatever is the loss processed, that will be your underreported income. In my case, suppose the loss assessed is how much? 2 lakh and the loss processed is 10 lakh. Therefore, the differential amount 8 lakh rupees is your underreported income. So, in loss cases, you don't have to do lot of efforts. You don't have to put lot of efforts. In case of loss, directly this 8 lakh rupees will become your deemed income, and directly on 8 lakh rupees you will compute what? You will compute your tax. I hope it is clear to all of you. And the next case is also something which we have done earlier. So, it doesn't make sense to repeat that again and again. Okay. So let's go ahead with the next part. Now section 270A is not completed. Don't worry about it. There are many small parts which are there in section 270A. So we are going to complete all of them one by one. Okay. Now what is the next part in section 270A? It is section 270A4 and section 270A5. That is intangible addition provision. Okay. Now what is intangible addition all about? Lot of time what happens that the assessing officer adds some items on a random basis. For example, if he doesn't find your gross profit proper, suppose if your turnover is 10 crore and if you're showing the gross profit as 2%, that is 20 lakhs. And if the assessing officer feels that the gross profit is not 2%, it is at least 20%. And therefore he added 20% in your income. That is, he added what, 2 crore rupees in your income. Okay. And that income which is making on a presumption basis, on a presumptive basis, that is known as intangible additions. The question is, can he make such additions? The answer is yes. The income tax law says that he can make such additions. Even the Supreme Court in the case of Anantharam Veera Singhai, it has held that it can add such kind of additions. And if you're not happy with that, you can make an appeal against the CIT appeal, okay, or a Joint Commissioner appeal. But he has the power to make such kind of additions, okay. Now the question over here is, can he take tax on that? Yes, definitely. If he makes an addition, he will take taxes on it. Can he take interest on that? Definitely he will take interest. Can he take penalty on that? He cannot impose penalty on that. So he cannot impose penalty on intangible additions. But after 30, 40, 50 days, if there is some unexplained money, unexplained bullion, unexplained jewelry found at your home, and if you start to explain the source that this unexplained money is out of that particular intangible additions which you have added 40 days back, if you start to explain that source, then in that case, it is deemed to be underreported income. Now, after 15 days, if 150 lakhs is found at your home, after 40 days, if 150 lakhs is found at your home, and if you start to explain that this 150 lakhs is out of the intangible additions, I have acquired, I have procured this from the intangible additions only, then the AO will start to make what? Penalty against you, and he can impose penalty against you. This is what this particular provision wants to tell you. The moral of the story of this provision is very simple, that the intangible additions will not be subject to penalty unless and until you start to explain the source of your unexplained income against the intangible additions. If the moment you start to explain the source of your unexplained income against the intangible addition, the AO can start to impose penalty on you, because it is called as deemed underreporting as per section 270A4 and A5. Okay. Now, suppose the AO has found some unexplained income, and then the AO has found some undisclosed income, and then the AO has issued a show cause notice, because I have told you at the beginning of this section that AO has to issue a show cause notice, or the CIT appeal or CIT has to issue show cause notice to impose penalty. Now, if you give a bona fide explanation, genuine explanation, then obviously he will not impose what? He will not impose penalty under the income tax law. Now, let's come to the very important point, that when 50%, when 200%. When the underreporting is normal, it is 50% penalty. But when the underreporting turns out to be a misreporting of income, then there can be a penalty of 200% of the tax payable. Sir, what is misreporting of income? The government has given some examples, some illustrations of misreporting of income where 200% penalty will be imposed as per section 270A8 and A9. That is, where you misrepresent or suppress your facts, then 200% penalty will be imposed. Where you fail to record the investment, where you claim expenditure for which there is no evidence by you, bogus expenditure, where you record false entry, where you fail to record any receipts in the book, where you fail to record any sales in the book, where you fail to report international transaction in transfer pricing, or deemed international transaction, or specified domestic transaction in transfer pricing, then it is called as misreporting, and 200% penalty can be imposed on you. And one last thing in this section, this will complete this section 270A, that is, if there is an unexplained investment which is found in your balance sheet, and the AO has imposed a penalty of 200%, and you have shown that in the balance sheet now later on as an explained investment, can AO impose penalty on that again in the next year? And the answer is no. Once you have borne the burden of the penalty, that asset will become white asset now. It's not a black asset now. It's a disclosed asset, and next year onwards the AO cannot impose penalty on that asset on you. Okay. Now, sir, I want immunity from this penalty. If you want immunity from this penalty and prosecution, then you have one option, that is section 270AA. In 270AA, whatever is the procedure written in 270AA, you have to follow that procedure. Under section 270AA, you will be getting immunity from penalty. But remember, the immunity is only allowed for 50% case. It is not allowed for 200% cases. Sorry for that. We will give you immunity only in case of 50% case, not in 200% case. Okay. Now, step 1. Make an application to AO. You have to make an application to AO for getting immunity within 1 month from the end of the month in which the order of assessment is received. So in whichever month the order of assessment is received, You have to make an application within 1 month from the end of that month. Okay. Plus, you have to pay the tax. You have to pay the interest within 30 days on the receipt of the notice of demand. So whenever you have received the order and you have received the notice of demand, within 30 days, you have to pay the tax and interest, because the immunity is not from tax and interest. The immunity is from the penalty. It's not from tax and interest. So tax and interest have to be paid by you. Plus, you should not file an appeal to CIT appeal or JC appeal against the assessment order under 143 or 144. Okay. So you should not file an appeal. Fourth, the AO will pass an order that whether he want to accept your application or reject your application. If he accepts, then he will immune your penalty. If he rejects, then he will not immune your penalty. Then he will pass an application. He will pass an order within 1 month from the end of the month in which such application is received. So whenever the application is received, he will pass an order. Now, if the order is rejected, you don't have an option to appeal against this order. Against this order, you cannot appeal. This order is final in every sense. You cannot file an appeal against this order. But you can file an appeal against your original assessment order. Against your original assessment order for which you have not filed an appeal in step number 3. Now you can file an appeal against that. You will get an extra time also to file an appeal. Okay. I hope it is clear to all of you. Last but not least, I have told you this is only for 50% case. This is not for misreporting cases. Misreporting cases are not covered over here. Okay. Now let's move on to the next penalty, which is a very important penalty again for your examination. A lot of question has been there in the question bank based on this penalty as well. 271 AAB. So what is 271 AAB? This is the penalty in case of search and seizure. Now, who can impose this penalty? Let me tell you. This penalty can be imposed by AO. This penalty can be imposed by CIT appeal. But this penalty cannot be imposed by JC appeal. JC appeal has not been given this power to impose this penalty under the income tax law. Now, before this penalty is how it is imposed, let me explain you the meaning of certain terms. This penalty is in case of search and seizure. Whenever there is a search and seizure at your premise, this penalty may be imposed on you. And before understanding this penalty, we need to understand the meaning of certain terms. First of all, just assume that on 15th of May 2023, there has been a search and seizure at your place. Okay. So on 15th of May 2023, if there is a search and seizure, let us try to understand the meaning of certain terms. First of all, what do I mean by specified previous year? There are two meanings of specified previous year. As per point number 1, specified previous year means a year preceding the date of search. A year preceding the date of search, that is 22-23, for which the due date of filing of return has not arrived. The due date of filing of return has not expired, and you have also not filed the return of income. Okay. So on 15th of May 2023, what is the preceding year? 22-23. For that year, is the due date of filing of return expired? Not expired on 15th of May. Have you filed the return? Not filed the income tax return on 15th of May. Nobody files here. The forms itself come in the month of June and July. How will I file the return on 15th of July? So point number 1 can be called as what? Can be called as specified previous year. Second point of specified previous year is very simple. It is the previous year in which the search is conducted. So in whichever year the search is conducted, that year will also be called as what? A specified previous year. So as per this point, the first specified previous year is 22-23 and the second specified previous year is 23-24. Sir, what is the specified date now? Now let's try to understand specified date. For first case, the specified date will be the date which will be the date of filing of return as per section 148. And as per section 148, what is the timing of return? What is the time to file the return? It is within 3 months from the end of the month in which the notice is issued. So in whichever month the notice is issued, you are supposed to file the return within 3 months from the end of that month. Okay. So that will be considered as the specified date. And for second case, the specified date will be the due date of filing of return as per section 139(1). That is what will be the due date of filing of return for 23-24. It will be 31st July 2024 or 31st October 2024 or 30th November 2024, whatever is the relevant date for the assessee. So first of all, whenever you do section 271 AAB, you need to derive these particular dates first of all. Specified previous year and specified date. Now listen to my provision. Now suppose on 15th of May 2023, the AO has entered your premise for doing search and seizure. Okay. Now the search is going on for 2 days, 15th and 16th. Now if in the next 2 days, if you explain the nature of your undisclosed income, that from where this undisclosed income has come, and you prove the manner in which undisclosed income has been derived, in which it was earned, when you are supposed to explain during the course of search, if you explain everything, that how this undisclosed income has come, prove the manner, pay the tax, and also file the return on or before the specified date, then the department will take a penalty of 30% of undisclosed income. So what all things you are supposed to do? You are supposed to explain the manner in which the income was derived. You have to give a statement in for section 132(4) during the course of search within that 2 days. You have to do everything within that 2 days. If you do everything within that 2 days and pay the tax and interest before the specified date, for 22-23 specified date will be the date as per section 148, and for 23-24 the specified date will be the due date of filing of return. And if you pay the tax within the specified date, then the AO will impose penalty of 60% or 30%. Otherwise, if you violate any of the condition which I mentioned in point number 1 over here, if you violate any of the condition, then the AO will impose a penalty of what? Penalty of 60% against you. This is what this dangerous provision is all about. Next one, are there penalties on professionals also? Yes. There can be a penalty on chartered accountant, on merchant banker, on registered valuer if they give incorrect information in a report or certificate. So if they give incorrect information in a report or in that certificate, they will be liable for 10,000 rupees penalty for every such report or every such certificate, and that will be imposed by AO, CIT appeal or Joint Commissioner appeal. They will definitely give you an opportunity of being heard, and if you are not able to explain your point properly, the AO, CIT appeal or JC appeal will impose the penalty on you. Okay. Section 274. What is the procedure to impose the final penalty order? The AO will give you an opportunity of being heard before passing the penalty order. Plus, if the income tax officer is imposing a penalty of more than 10,000 or the assistant commissioner or deputy commissioner is imposing the penalty of more than 20,000 rupees, they have to take a prior approval from the joint commissioner. Okay. So if these authorities are exceeding the amount of penalty, they have to take a prior approval from the joint commissioner, and the penalty is also going to be faceless under the income tax law now onwards. Okay. Let's talk about the next section. Penalty for fake invoice. If you pass a false entry in the books of account, or if you omit a correct entry from the books of account to evade tax liability, there can be a penalty equivalent to that entry. Suppose if I pass a false entry of 1 crore rupees, or if I delete a correct entry of 1 crore rupees, there can be a penalty of 1 crore rupees on me. Or if somebody provokes me, if my chartered accountant provokes me, if my lawyers provokes me, that pass fake entry, then in that case, that chartered accountant, that lawyer will also be impossible with what? A penalty of 1 crore rupees. See this, if at any proceeding during it is found under section 271 AAD, it is found that in the books of account that there is a false entry or there is an omission of any entry, then the AO commissioner or the joint commissioner appeal will impose a penalty equivalent to the false entry or omitted entry. Second point, which is talking about the chartered accountant, any person who has forced you or who was the cause behind you, who was the reason behind you to pass that entry, like a chartered accountant or a lawyer or an accountant, then those people will also be liable for what? A penalty under section 271 AAD. Sir, what do we mean by false entry? A false entry means an entry based on forged documents. False document, the document itself is false, or the documents is correct, but you are not purchased anything from any person, still you have passed this entry. Third, you have purchased also, you have not purchased anything from any person and you are passed an entry in the name of a person, that person only does not exist in this world. Okay, you are just passing a journal entry in the name of Mr. X, Mr. Y, that Mr. X, Mr. Y does not exist only in this world, and you are passing this entry and you are feeling that the income tax department is full. Okay, they will impose a penalty on you of equivalent to the amount of entry. Okay, so be very careful. Now let's talk about some positive things in life now. How to waive penalties under income tax law. The CIT has the power to waive penalty under section 273. Now there are two sections in which the CIT can waive penalty. One is 273A1, another is 273A4. But what is the difference between the two, sir? In 270A1, he can reduce your penalty under section 270A only. Only 270A penalty will be reduced. Not all penalty will be reduced or waived. But under 273A4, he can reduce your any penalty, including 270A. All penalties can be waived over here, or it can be reduced over here. Secondly, under A1, the CIT can suo moto also reduce your penalty. You can also make an application, but in 273A4, you have to make an application. CIT suo moto will not reduce your penalty. Third case, if the concealed income is more than 5 lakh rupees, then the CIT has to take an approval from Chief Commissioner or Director General. What has to be greater than 5 lakhs? Concealed income is greater than 5 lakhs. Then take approval from Chief Commissioner or Director General. But in the right hand side, if the penalty is greater than 1 lakh, not concealed income, the penalty is greater than 1 lakh, take approval from Chief Commissioner or Director General by the Commissioner of Income Tax. Okay. Next conditions to be fulfilled. On the left hand side, you have to fulfill the following condition. You have to be a very cooperative assessee. You have to make the payment of taxes and interest, and you have to give true and full disclosure voluntarily. Voluntarily, you have to go and give full and true disclosure. Be an honest assessee. The CIT will impose your penalty. Right hand side, there should be genuine hardship on you, financial hardship. Financial problem has to be there on you, and there has to be cooperation. Cooperation is there on both the side. Okay. Next point, left hand side, if the penalty is paid it can be refunded also. Refund is also possible. But on the right hand side, no waiver is possible if penalty is already paid. If penalty is already paid, refund is not possible. Left hand side, the AO will pass an order at any time. The CIT, will pass an order at any time. There is no time limit under the income tax law. On the right hand side, there is a time limit of 12 months on the end of the month in which the application is received by the CIT. So on the left hand side, there is no time limit by the CIT to pass an order. On the right hand side, there is a time limit of 12 months by the CIT to pass an order for whether he want to waive or he doesn't want to waive. He will say within 12 months. Now, there are some common points on both the sections. There are some uncommon points also. Let me talk about all of them. The penalty waiver under 273A is once in a lifetime if it is made in your favor. So once it is made in your favor, it cannot be made in your favor once again in your lifetime. So this penalty can be waived only once in your lifetime and not for the second time. If you're not happy with the final order of 273A, no appeal is possible against such order. Appeal is not a remedy under income tax law. Yes, writ petition can be filed by you. If you want to file a writ petition, you can go and file a writ petition under the High Court as per the Code of Civil Procedure. Okay. Now, both the orders which the AOCIT will pass has to be a speaking order. Speaking order means the order should mention the reason why the penalty is not waived or why a penalty is waived only to a particular percentage, why entirely it is not waived. Fourth one, you can make application for n number of years. There is no restriction is that. Fifth one, if an income is detected in trade, then the waiver is not possible under both the section. 273A1 is also not possible. A4 is not possible. Fifth one, if the assessee is satisfying all the condition, then the CBDT has said that the CIT is bound to waive the penalty under 273A. Therefore, if the assessee is fulfilling all the conditions mentioned under this section, the CIT has to waive the penalty under 273. Okay. Next, the CIT cannot waive interest under 234 ABC. That power is only there with the Chief Commissioner and Director General of Income Tax. CIT does not have the power to waive interest under 234A, 234B and 234C. Next, genuine hardship should exist both at the time of application and also at the time of passing the order. Suppose at the time of application, genuine hardship was there, but at the time of passing, genuine hardship was not there. Penalty cannot be waived under the income tax law. Okay. Again, the next one is very simple, which I have told you earlier also. You can make application for n number of years and CIT will consider all the application together and will pass the order. And once the penalty is waived, the department will also drop your what? Prosecution proceedings under the income tax law. That will also be dropped under the income tax law. Okay. Next one, cash credit 68 to 69D. Very dangerous provision. Unexplained cash credit, unexplained money, bullion, jewelry, etc., etc., etc. Now, what does this section says? This section says that where any sum is found credited in your books of account, and if you are not giving explanation or your explanation is not satisfactory, then your money will be, that sum will be considered to be the deemed income in your case. Now, the government has gone one step ahead. If somebody has given you a loan or somebody has given you a borrowing, you have borrowed some money from your friend, then you have to also explain the source of money in the hands of your friend, from where your friend has got the money. If you are not able to explain the source of income in the hands of your friend, then also it is deemed income in your case. Be very careful. If you borrow money from someone, you have to also explain the source in the hands of the lender. If you are not able to explain the source in the hands of the lender, you will be liable for income tax under the income tax law. And how much income tax? That we'll see in a while. Third one is for closely held company. If there is a closely held company which is raising money from its shareholder and the shareholders are resident, then the company also is to explain from where the shareholders have got the money. The company has to explain from where the shareholders have received the money. The company has to explain that also from where the shareholders have received the money. And if the company is not able to explain from where the resident shareholders have received the money, then the closely held company will be under default and closely held company will be liable for income tax as per this provision. But this provision is not applicable for venture capital fund or venture capital company. Okay. So if you raise money from venture capital or venture capital company, then this provision is not applicable, not applicable, not applicable. Next one, section 69, unexplained investment. If there is some investments which are not recorded or for which no explanation is given by you or the explanation given by you is not satisfactory, then that can be deemed to be income. Similarly, unexplained money, unexplained bullion, jewelry, other valuable article, no explanation or weird explanation, not satisfactory explanation, deemed income. Similarly, if you are not disclosing full assets in your books of account, section 69B, you have bought an asset of what? 10 crore rupees, but you are disclosing only 3 crore rupees. The excess amount will be considered as what? Deemed to be income. 10 crore rupees will be deemed to be income under the income tax law. Okay. Next one, unexplained expenditure. If you incur any expenditure for which there is no source of income, From where you have incurred that expenditure? You don't have the answer only to that particular question. Example, you have done some marriage, you have done some party, and the department is asking you from where the hell you have got the money to incur such expenses. You're not able to answer that. Then that income will be that amount will be called as what? Unexplained expenditure. It will be deemed to be income. Okay, and you will be liable for income tax under the income tax law. One more thing, if you incur any expense from an unexplained expenditure, in case of an unexplained expenditure, you will not get the deduction also of that expenditure under the income tax law. Okay, that expenditure will also not be allowed under the income tax law. One last thing, if section 69D, if you have borrowed any money on hundi or if you have repaid any money on hundi otherwise than by an account paycheck. So if you have raised money through hundi through an other than account paycheck, or you have repaid through other than account paycheck, then that is also deemed income. But there is one relaxation over here. When you raise the money by cash. So that is deemed income. So now when you repay the money again in cash, again deemed income will not happen. Deemed income will happen only at the time of borrowing or at the time of repaying whenever you pay cash. Okay. If you are paying cash at both the time, then deemed income will not happen two times. Okay. Two times income tax will not be imposed. Last but not least, in all these cases from section 68 to 69D, what will happen? There will be a dangerous tax against you under section 115 BBE, that is 78% tax, 60% tax, 25% surcharge on this, and then 4% cess, which comes to 78% tax on your income, plus. No deduction of any expense or allowance or expenditure shall be allowed against you. Nothing will be allowed to you. No deduction of any expense, any allowance or any losses will be allowed against this income. It will be directly taxable to you. Okay. Now, will penalty will also be imposed, sir? Yes. In such cases of section 68 to 69D, a penalty will also be imposed on you. That penalty will be imposed by AO, CIT appeal or JC appeal. And other than 271 AAB, that is if it is a search and seizure case, then 271 AAB will apply. But if it is not a search and seizure case, then a penalty of 10% of the tax payable under 115 BBE. So whatever is the tax payable under 115 BBE, you have to pay 10% penalty of that under the income tax law as per this provision, as per 271 AAC. Is there any way to get away from this penalty? Is there any way to get escape from this penalty? Yes, there is only one way to get escape from this penalty, that is furnish ROI and then pay the tax as per 115 BBE before the end of the previous year. So if you furnish the ROI, show the income in the ROI and pay the tax before 31st March. Whenever you are caught before 31st March of that year, if you have paid the tax, no penalty will be imposed under this section. Even penalty under 270A will not be imposed on you. Okay. Now let's talk about section 269 SS and section 269 T. No person shall take from any other person. So if I am taking any loan from you, any deposit from you, or any specified sum from you, other than the four modes means account pay check, account pay draft, ECS and such other electronic mode. If I take the loan in cash from you, so the cash loan should not exceed 20,000 rupees or more. Okay. So if I take a cash loan of 20,000 rupees or more from you, I am gone. I'll be liable for a penalty under section 271D, which is equivalent to the amount of cash loan and which will be imposed by the Joint Commission of Income Tax. This is what point number A has to say. What does point number B has to say? The point number B says that on the date of taking the cash loan, whenever you are taking a cash loan, if there is any outstanding loan of 20,000 or more, so if there is already an outstanding of 20,000 or more, I cannot take a single rupee cash loan from you. For example, I have already taken 50,000 loan from you. So there is an outstanding of 50,000 in my balance sheet. Now I cannot take even a 2,000 rupees cash loan from you. Even if I take 2,000 cash loan, I will be getting covered in point number B now. Point number A talks about individual loan. Point number B talks about outstanding on the date of taking cash loan. So on whichever date you take the cash loan, on that date, what is the outstanding? If the outstanding is already 20,000 rupees, I am gone. I cannot take a single rupee as cash loan. And what is point number C? Point number C is an aggregate of A and B, that is cash loan along with outstanding on the date of cash loan. Both of them should also taking together should not exceed 20,000 rupees or more. Exact 20,000 is also not allowed because the law is using the word 20,000 rupees or more. For some people, the government has increased this limit 10x to 2 lakh rupees. For whom it is increased? If the deposit is accepted by Primary Agriculture Credit Society or Primary Cooperative Agriculture and Rural Development Bank from its members, or such loan is taken from Primary Agriculture Credit Society by its member, from its members or by its member. If the loan is taken from its member or by its member, then the limit is what? Then the limit is 2 lakh rupees. It is both the way, both the case. If the loan is given by member or if the loan is given to member, in both the cases, it is 2 lakh rupees. So up to 2 lakh rupees, you don't have to worry in that case. Okay. I hope it is clear to all of you. Now, further, this section is not applicable to few more people. This section shall not apply to any loan or deposit accepted by government. If the government is taking loan, they can accept cash loan. A banking company can take loan from you. Post office can take loan from you. Cooperative bank can take loan from you. Any corporation which is established by central, state or provincial act, they can take loan from you. Government company can take loan from you. Okay. Now, there are 3 points mentioned over here. One is loan, one is deposit, and one is specified sum. Sir, what is specified sum? Specified sum means you have taken an advance from someone with respect to our immovable property. Suppose I have taken an advance from you and I have told you that I will sell you my immovable property, give me advance. So that advance also I cannot take in cash. That also I should accept in 4 modes only. That is, what are the 4 modes? I just forgot that. Account pay check, account pay draft, ECS and such other electronic mode. Then whether or not the transfer takes place, later on if the transfer does not take place, still you're not supposed to accept cash from anybody. Okay. One last thing over here is, I am agriculturist, you are agriculturist. I am farmer, you are farmer. My income is below basic exemption limit, your income is also below basic exemption limit. And if I am taking loan from you, then I can take the loan in cash. It is allowed as per the income tax law. Both should be farmer, both income should be less than basic exemption limit. Then you can accept the loan in cash. There is no harm in that. Okay. Now let's talk about the reverse section of this. That is 269TTT. What is 269T? 269C puts restriction on repayment of loan of 20,000 rupees or more in cash. Now, even bank cannot repay your loan in cash. Okay. Even bank cannot repay. And when you repay the loan, you have to check the principal as well as interest taking together should not exceed what? 20,000 rupees in cash. Suppose if I have taken a loan from you of 18,000 rupees and now I'm repaying you 21,000 because I have to pay you interest also of 3,000 rupees. So I have to consider 21,000 rupees as my payment, and that should not be more than 20,000 rupees. If that is more than 20,000 rupees, then I am liable for what? Penalty under 271E, which will be imposed by Joint Commissioner, which will be equal to the amount of loan or deposit or specified sum taken in cash or repaid in cash. Okay. So now again you have to think like this. So if you repay, including now even bank cannot repay you in cash up. Even bank is not allowed to repay the things in cash. Bank also has to repay the things in what? You can repay the loan to bank in cash, but bank cannot repay you in cash. You can repay to bank in cash, but bank cannot repay you in cash. So if bank is repaying you any loan, deposit, specified sum, or any person is repaying 20,000 rupees or more, it should be not in cash. Okay. It should be in 4 modes. Similarly, if the outstanding in the balance sheet is 20,000 rupees or more, I have taken a loan of 1 lakh rupees from you. So in my balance sheet, there is an outstanding already 20,000 rupees or more. Now I cannot repay you a single rupee in cash. That is not allowed, not allowed, not allowed. Single rupee also in cash is not allowed to be paid by me to you. Okay. I hope it is clear to all of you. Third one is similarly specified advance. The way it was what? Specified sum. When you accept it is specified sum. When you repay it is a specified advance. Okay. So even specified advance should not be given of 20,000 rupees or more in cash. Okay. Now a similar amendment has come here also, that primary agriculture credit society, etc. For them the limit has increased to how much? For them the limit has increased to 2 crore rupees. Okay, I hope it is clear to all of you. Now few people it is allowed to repay in cash. That is, who are those people? Nothing contained in this section shall apply to repayment of any loan taken or accepted from. If you are taking a loan from government, you can repay in cash. If you are taking a loan from bank, post office, cooperative bank, you can repay in cash. So again I am saying you can make the payment in cash to bank, but bank is not allowed to make the payment to you in cash. You can make the repayment in cash to bank. Bank cannot repay you in cash because that is not allowed as per this section. Okay. Third, again, corporation established by central, state or provincial act. And fourth, even government company, they can also repay in cash. Okay. They can also accept a repayment in cash from you. Okay. Now, there is one circular over here which says that the penalty under this section will be imposed by Joint Commissioner. Any officer below the rank of Joint Commissioner has to intimate to the Joint Commissioner, and accordingly the Joint Commissioner will impose the penalty. An officer below the rank of Joint Commissioner cannot impose penalty under 271D and 271E. I hope it is clear to all of you. Okay. Now next few points are there. Let us address that and then we'll go ahead with the next topic. Change of incumbent of an office. What is change of incumbent of an officer? Suppose there is an officer who was doing your assessment and suddenly his transfer happened or he expires. Then a new officer came. Okay. So if a new officer comes, then the new officer will continue the discussion from where the original officer has left it. Okay. The new officer will continue the discussion from where the original officer has left. Okay. I hope it is clear. And can a new officer, can the assessee ask for rehearing of the matter which was considered by the original officer? Yes, the assessee can ask for the matter to be reheard which was already heard by the original officer. So if the original officer has heard some matter for 6 months, now he has expired or he has transferred, new officer has come, you as an assessee, you have been given the power under section proviso to section 139 that you can, 129 sorry, you can tell the new officer that please rehear the matter which was already heard by the original officer. Okay. Now the next one is a small section which is removed by the income tax law. So I am not talking much about that. Section 276A, which was some kind of prosecution, which is removed now from 1st April 2023 onwards. They have removed this particular section. So let us not talk much about it because it is removed by the income tax law. So why to talk about it unnecessarily? Next, section 272A, penalty for certain failure. So if an assessee failed to answer some questions which are asked by the department, failed to sign statement, fail to furnish statements, fail to furnish information, fail to file the returns, fail to file statements, fail to allow inspection, then the department can impose a penalty of rupees 500 every day during which the failure continues. So for whichever time the failure will continue, the department will impose penalty of 500 rupees on you for every day. Okay. Now there are some major functions which I have put over here just for your knowledge. They are not going to ask you any questions like that, but a lot of students have a lot of doubt here. What does CIT do? What does principal CIT do? What does chief CIT do? So I have put some major functions over here. Like just I'll go through them, all of them. CIT and principal CIT, what is their major function? They supervises the authority below them, that is assessing officer. They can do 263, 264 revision also. They approve religious and charitable trust. They have the power to reduce or waive penalty under 273 just now we have done. They have the power to grant approval for certain notices under income tax law. They have the power to approve provident fund, gratuity fund. They can reduce or waive interest under what? Section 220 also. What does chief CIT and principal chief CIT does? The first point is they will supervise the commissioner below them. They have the power to reduce or waive interest under 234 ABC also. This power was not there with the above authority. They can grant approval of certain notices and directions. They can also provide approval for certain provident fund, gratuity fund, superannuation fund. They also have the power to reduce interest under 220. They also have the power to do revision under section 263 and 264. I hope it is clear to all of you. Let's move ahead with the next point, and that is dispute resolution committee. First of all, let us not get confused between dispute resolution committee and dispute resolution panel. Dispute resolution committee will waive your penalty and prosecution, and dispute resolution panel will take your matter in case of transfer pricing, etc. Transfer pricing, and in case of non-resident assessee, dispute resolution panel is relevant to hear like an appeal. They are like an appellate authority. Okay, dispute resolution panel is like an appellate authority, but dispute resolution committee is a committee which will waive your penalty under the income tax law, or which will give you a waiver from prosecution under the income tax law. So let's talk about the provisions of section 245 MA. The central government will constitute one or more dispute resolution committee. Okay, so one or more. The central government can make one dispute resolution committee also. They can make more than one dispute resolution committee also to resolve disputes of such person which are specified. For assessee, it's an option. The assessee may opt for dispute resolution committee, or assessee may not opt for DRC. I will say DRC henceforth, it's a very long name. Okay, so assessee may opt for DRC, assessee may not opt for DRC. Now, who qualifies? Who is the assessee who can go for DRC? The following assessees can go for DRCs whose returned income is 50 lakhs or more. The income in the return has to be, the income in the return has to be 50 lakhs or less, 50 lakhs or less, 50 lakhs or less. And the aggregate variation by the AO in the order has to be 10 lakh or less. So the return income should be 50 lakh or less, and the AO's order should be rupees 10 lakh or less. Okay, it has to be rupees 10 lakh or less. Be very careful. And you have to fulfill some other conditions also which are provided under the income tax law. Apart from that, so again, this is a very important condition. The return income has to be 50 lakh or less, and the variation by the AO has to be 10 lakh or less. If you fulfill these two conditions, you have crossed the first barrier. Few more conditions have to be fulfilled. In fact, many more conditions have to be fulfilled. Secondly, there should not be any search against you. There should not be any search against you. Any requisition under 132A, which is a part of search only. There should not be any survey against you. There should not be any information which is received under DTAA under section 90 and 90A by the assessing officer. You should not be covered in all these cases. Okay. Then the power of DRC is they can reduce your penalty, they can waive your penalty, they can grant you immunity from prosecution also. Okay. There are few more people who are not allowed to come under this section. That is, who are covered under different laws. Suppose you are already having an order, there is already an order against you under the Conservation of Foreign Exchange and Prevention of Smuggling Act 1974, or if there is already an IPC law which is going against you, unlawful activity prevention law going against you, narcotic drugs law which is going against you, Benami transaction law, Prevention of Corruption Act, Prevention of Money Laundering Act, all these law, if it is already against you, then you cannot come under this section. Okay, then you cannot come under this section. If the prosecution has already been initiated by the income tax authority, then also you cannot come under this. If there is some special trial court act etc. against you, then also you cannot come under this particular law. Okay, now the next paragraph is about passing of order etc. 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 We will be talking about that sometime later when we'll be talking about what? The dispute resolution panel. Here the concept of dispute resolution panel will also come into picture, but right now I'm not speaking. I'll be speaking along with the dispute resolution panel. Right now I'm not speaking. Now this proceeding will also be what? Faceless. Now how this proceeding will entirely run? For that purpose the government has given a complete notification over here. So I'm speaking about the notification now. So pay attention please all of you. First of all, what is the constitution of DRC? Who will be there in DRC? Who will be listening to my points? Who will be there as an authority? The DRC will comprise of, the government will make DRC for every principal chief commissioner region. So in whichever place there is a principal chief commissioner of income tax, for that place the government will make one DRC also. So under every principal chief commissioner, there will be one DRC also. DRC will comprise of what? It will comprise of three members, out of which two members would be retired officer from Indian Revenue Service, two retired officer who have hold a post of CIT or equivalent or higher post. So two commissioner of income tax or higher post people who have been commissioner for at least how many years? 5 years or more, and one serving officer not below the rank of principal commissioner or commissioner as specified by the board. So two retired commissioners of at least who have worked for 5 years in the income tax department, and one serving officer. Okay. Now the members would be appointed for how many years? They will be appointed for 3 years. Whether the member will be paid any fees? Yes, the retired member will be paid fees on a per cases basis along with the setting fee. They will be given some setting fee along with the per cases basis. Sir, only retired member. What about the serving member? The serving member will not be given any fees. No, they are getting salary now from the income tax department. So why the government will give them separate fees separately? The fees is only to be paid to the retiring member, not to the serving member. The decision will be taken by the majority. 2 out of 3 will be the decision of the DRC. I hope it is clear. The central government may remove any member after recording the reasons and after giving opportunity of being heard. If the central government wants, they can remove any member by giving an opportunity of being heard. Okay. Now, what is an application? Yes, you have to make an application to the DRC and you have to make a fee of 1,000 rupees you have to fulfill, and you have to fulfill certain conditions which I have already told you, and you should not be covered in black money law also. Black money law also, it should not be against you. If a black money law is imposed against you, you cannot come to DRC. DRC doors are open for you, are closed for you if the black money law is already imposed on you. Okay. Now, by when I should make an application? Where appeal has been already filed before CIT appeal. So if you have already filed an appeal, then you have to file an application to DRC within such time from the date of constitution of DRC. So whenever the DRC was constituted, within few days after that, as the government will prescribe in the law. The government has not prescribed that. And in any other case, within 1 month from the date of receipt of the specified order. So when this case is more important for you as of now. So if there is any other case, you have to make an application to the DRC within 1 month from the date of receipt of the specified order. Specified order means what, sir? Specified order means all these orders can be called as specified order. Suppose if there is a draft order which is made by DRP, which is made by AO under 144C subsection 1, which will now go to dispute resolution panel later on, which will be applicable in the case of transfer pricing. That is a specified order. Or 143(1) intimation is also a specified order. 200A1, 206CB1, TDS and TCS intimation is also a specified order. Assessment order, reassessment order 143(3), 144, 147. Then 154 rectification order is also a specified order. Then 201 assessee in default for TDS and TCS can also be called as what? Specified order under the income tax law. Then the conditions are repeating. The aggregate variation by the AO does not exceed 10 crore rupees, and the total income in the return does not exceed how much? 50 lakh rupees, because all these conditions are repeating from above only. Okay. And then there should not be any search against you, requisition against you. There should not be any survey against you. There should not be any information received from DTAA under the income tax law. Okay. Now, once you have given the application, what will the DRC do? DRC will examine the application, and where the DRC consider that it should be rejected, DRC will issue you a show cause notice and will reject your application. Okay. And DRC will give you an opportunity of being heard through video telephony or video conferencing. Okay. The assessee has to furnish a response to the show cause notice within the specified date and time, as extended as may be allowed. So DRC will give you an opportunity of being heard for rejecting an application. Okay. Now, if the DRC, where the DRC may, after considering the response, either reject the application. After your response is given, the DRC may either reject or DRC may decide the application on the merits in your favor. Or where no response is furnished by the assessee, obviously DRC will what? Will reject the application. Okay. And then the assessee may file an appeal to the CIT appeal. Okay. Now that will be communicated to the assessee within 30 days of the receipt of the communication. The application is admitted. The assessee is required to submit a proof of withdrawal of the appeal. Okay. Now if your application is admitted by DRC, now be very careful. If your application is what? Accepted, then you have to give a proof to the DRC within 30 days that I am not going to appeal now. The appeal powers I have waived off. I don't want to appeal. I want to lie my case with you only. You only take care of my case. I don't want to appeal. Okay. Now, what is the procedure of DRC? DRC will call for the records for further examination. DRC will call for the reports from the assessing officer. DRC will ask for further information from the assessee. DRC will submit the information or submission of response within the specified time. Whatever information DRC has asked from you, you have to submit the information within the specified time. Now the time has come for the DRC to pass the order. Now see what kind of orders DRC can pass. DRC will make modification in the variation in the specified order. So whatever variation AO has done now, the DRC will pass an order that this variation is wrong. 10 lakh, 7 lakh rupees income cannot increase. Reduce this income. The DRC can do that, and DRC can waive your penalty under the income tax law also. Second, DRC will not make modification. 7 lakh which is added, he will keep that 7 lakh as 7 lakh only. He will not change the income, but he will waive your what? He will waive your penalty. He will waive your penalty. And the third one is, he will not waive your penalty, he will not waive your income also. So that is an order which is against you, and that order which is against you, you cannot file an appeal against this order, and all these things will be done within 6 months from the end of the month, and with the application for dispute resolution is admitted by the by the DRC. Now, some small procedure now. Serving of copy of order to the AO, no appeal or reference will lie against the modified order. Serving of copy of order to the assessee, the order will be given to assessee, the order will be given to the AO. Whatever order you have received, you cannot file an appeal against that. You can file a writ petition in the High Court. Then the assessee has to furnish the proof of payment of demand, and then the DRC will grant you what? Immunity from penalty and prosecution. Okay. Now, in some cases, the DRC will terminate the proceedings. If the DRC feels that the assessee fails to cooperate, assessee fails to cooperate to the DRC, DRC will terminate the proceeding. If the assessee fails to respond to any notice, DRC will terminate the proceeding. If the assessee has concealed any particulars or given false evidence to the DRC will cancel the proceeding and terminate the proceeding, and the matter will be sent back to the income tax authority. If the assessee fails to pay the demand as per the notice of demand, because you are not going to be waived from penalty, you are not going to be waived from the notice of demand. Not tax and interest you have to pay. You will be waived from penalty, not from your taxes and interest. Now, so if you fail to pay your demand on time, then the DRC will what? DRC will what? Terminate your proceeding. Last but not least, 44 DAC. What does this section say? This section says that the DRC will give you immunity from penalty and prosecution subject to few conditions. That is, pay the tax on the returned income in full and cooperate with the DRC. The reason will be recorded in writing. No immunity if the prosecutions were already initiated. If the prosecutions were already initiated, the DRC will not give you any kind of immunity. And while giving the immunity, the DRC will put some conditions. In future, if you violate any of the condition, in future, then the DRC will withdraw your immunity and will impose penalty on you, will withdraw your penalty. So while granting the immunity, he will put some conditions. You have to fulfill those conditions. If you don't fulfill those conditions, he will waive off your penalty. Okay. He will waive off your immunity, and he will not give you what? Waiver from the penalty and prosecution. Last but not least, just for your knowledge, I put this. The following orders are not appealable under the income tax law. First is the revisionary order under 264, not appealable. Second, 143, 147 order is not appealable if penalty is waived under 270AA. If 270AA AO waives your penalty, then you cannot appeal against 143, 147. Okay. 270AA order is also not appealable. 273A penalty waiver order by CIT is also not appealable, and this order of 245MA is also not appealable. Okay. So this is what this small topic is all about. So let's go ahead with the next topic, and that is set off and carry forward of losses. The very first thing that we are going to see in this chapter is section 73, which is intra-head adjustment. Intra-head adjustment means you have to set off within the head. You cannot go outside the head. PGBP loss will set off against PGBP. Capital gain, capital gain. IFOS, IFOS, HP, HP. Okay, you will not go beyond your head. You will set off within your head. Now in this, there are 4 restrictions. First, speculation business loss can set off only against speculation business income. It cannot set off against non-speculation business income. But is the reverse possible? Yes, reverse is possible. Non-speculation business loss can set off against speculation business. Be very careful. Non-speculation business loss can set off against speculation business, but speculation business loss cannot set off against non-speculation business. Be very careful. Okay. Next one, loss from the activity of owning and maintaining racehorse can set off only against similar income. It cannot set off against other income. Third one, long-term capital loss cannot set off against short-term capital gains. Long-term capital loss can set off only against long-term capital gains. It cannot set off against short-term capital gains. But can short-term capital loss set off against long-term capital gains? The answer is yes. Short-term capital loss can set off against long-term capital gains. That is possible. Okay. Next one, 3580 loss cannot set off against any other business. 3580 loss can set off only against 3580 income only. It cannot set off against any other business income. So what is 3580? 3580 is investment linked deduction. It can set off only against similar business income. It cannot set off against other business. Okay. Now, once your intra-head is done, that is intra-head means within the head loss set off is done. Now you can go to other heads and set off your loss. But in that also there are a lot of restrictions. First restriction is speculative business loss cannot set off against other heads. Forget about other heads. Within the head also it can set off only against speculative business income only. It cannot be set off against non-speculative business income also. So the question of setting off against other head is impossible. Okay. Next, horse race losses can set off only against horse race income. Next, capital gain loss can set off only against capital gains income only. And in that also there is restriction. It cannot go to other heads. within the head also there is restriction. Long-term capital loss cannot set off against short-term capital gains. Okay, that is not allowed. But yes, short-term capital loss can set off against long-term capital gains. Next, very important. PGBP loss cannot set off against salary. PGBP loss is not allowed to set off against salary. Next, 3580 loss can set off only against 3580 business. It cannot be set off against other business. Okay. Next, house property loss. If it wants to set off against other heads, then it can set off only to the extent of 2 lakh rupees. It cannot set off more than 2 lakh rupees. Okay. House property loss, if it wants to set off against other house property income, it can set off without any limit. Even more than 2 lakhs can set off. But house property loss against other heads, house property loss against PGBP, against CG, against IFOS, against salary, it cannot set off more than 2 lakh rupees. I hope it is clear to all of you as per section 71B. Last but not least, if you are having some loss from exempt activity, then the loss of exempt activity cannot set off against what? Against the income of taxable nature. So exempt losses will be lapsed. It cannot be carried forward and set off under the income tax law. Now, once that is also done, if still loss persists, then what will you do? Then you can carry forward the loss. So first loss which we are going to carry forward today is house property losses, and how it is carried forward. It can be carried forward and now set off only against similar income. Always remember, once you carry forward the loss, then you cannot carry forward and set off against other heads. You have to carry forward and set off against the same head only. So in the current year, you will set off against any income, but in the subsequent year, for 8 years, you can carry forward and now you will set off only against house property only. You are not going to set off against other heads of income. Okay, I hope it is clear. Further, to carry forward and set off the house property loss, there is no need to file the return also on time. You can file a late return and you can carry forward and set off the loss. That is also allowed. Okay. Now next one, section 72, which talks about non-speculative business income. Non-speculative business loss, it can set off against only against PGBP. It can set off against speculative business also, non-speculative business also. There is no harm in that. Non-speculative business loss can set off against both speculative also, non-speculative also, and it can carry forward and set off for how many years? For 8 years. Even if the business is discontinued, still you can carry forward and set off against your other businesses. It is allowed to set off and carry forward against other business also. Okay. Now, there's a fundamental rule of carrying forward and set off of loss, that a business loss can be incurred by those people who has, it can be set off by those people who has actually incurred it. If I have incurred the business loss, only I can set off. My father's business loss, I cannot set off. My mother's business loss, I cannot set off. But there is one exception to this, where there's a death of an individual. Suppose there is a death of an individual and I am the legal heir of that particular person. There is a death of husband and the wife is the legal heir. There is a death of father and son is the legal heir. Then the legal heir can set off the loss for the balance number of years. It is allowed to set off the loss for the balance number of years. It was even held by Supreme Court in a lot of cases. Like it was held by Supreme Court in the case of Madhukant M. Mehta, where there was a proprietor who died and there was a business which was done by the proprietor. So he expired, he passed away. After that, his wife and his daughter made a partnership firm and continued that business. Whether that loss can be set off by the partnership firm or not. The answer is yes, because the wife is a successor and is a legal heir of the husband. On death of the husband, the wife can carry forward and set off the loss. There was another assessee by the name called as Pramod Mittal, Delhi High Court, where what happened, there was a firm in which there was a loss. Therefore, the firm got dissolved. So after the dissolution of the firm, now the partners are saying that we want to carry forward the loss. That is not allowed. Dissolution of firm is not death of individual. This exception is only available in case of death of an individual. This exception is not available in case of dissolution of a firm. Okay. I hope it is clear to all of you. Now, generally, the losses can be carried forward for PGBP loss can be carried forward for how many years? For 8 years. Okay. Non-speculation business loss can be carried forward for 8 years. But there are 3 exceptions in which you can carry forward for more than 8 years also. First, 3580 loss, if it is there, you can carry forward without any limit. There is no time limit under 3580. Second one, be very careful. Suppose around 20 years back, say in previous year 1995, in previous year 1996, there was a loss of 10 lakh rupees in my business. Okay. Now in 2023, 2024, and therefore I discontinued the business in 95-96. Now in 2023-24, I recovered around, say, I recovered 25 lakh rupees as a bad debts recovery under 41(4). So be very careful. Around in 1995-96, there was a loss of 10 lakh rupees and the business got discontinued in 95-96. And in 23-24, I got some recovery from the debtors. The debtors came to me and gave me the money of 25 lakh rupees. So now the question is, law says that whatever loss was there in the year of discontinuance, you can set off against this income. This is what the law wants to say. As per section 41(5), if the business was discontinued, yes, it was discontinued, and there is an income chargeable under 41(1), 41(3), 41(4), 41(4)(a), then the business loss of the previous year in which the business was discontinued. So in whichever year the business was discontinued, in my case it is 95-96. you can set off that loss against such income of 41.1, 41.4, 41.3, 41.4a. You can set off that much loss. Sir, what about the losses prior to 95-96? The losses prior to 95-96 will not be allowed to set off because the law is very clear. The loss pertaining to the previous year, the loss of the previous year in which the business was continued. The only in the year in which the business was discontinued, that year's loss you can carry forward and set off. You cannot carry forward and set off the losses of earlier years. Okay. So there is an example on this over here. You can check it over here. The third exception where you can carry forward the loss for more than 8 years. Okay. Suppose your business is going on and it is discontinued because of some circumstances given in 33B. Then what is given in 33B? In 33B, there are circumstances like floods, earthquake, cyclone, war, etc. These are the circumstances given under 33B, and 33B says that you have to reinstate your business within 3 years. So suppose your business was going on good and suddenly there was a flood or earthquake or war, etc. and your business got collapsed. It got closed, and now within 3 years you are reinstating your business. So whatever loss was there earlier, all the losses you can carry forward for another 8 years. This is what the law wants to say. So whatever loss was there earlier, including the brought forward loss, whatever loss was there in the year of discontinuance, including the brought forward loss, will be allowed to set off in the year of re-establishment and another 7 years. So you can carry forward the loss for another 8 years, including the year in which you re-establish the business. Okay. So again, an example is given over here. You can check it over here. Now, next loss which we want to carry forward is Section 73, speculation business loss. Speculation business loss can be carried forward only for 4 years and it should set off only against speculation income. It cannot set off against non-speculation income. Next one, 73A, specified business loss, 35AD. 35AD business loss can be carried forward without any time limit indefinitely and it can set off only against 35AD business income. It cannot set off against other business income. Only against 35AD business income you can set it off. Okay. Next one, Section 74, capital gain loss. Capital gain loss you can carry forward for 8 years and it can set off only against capital gains income. In that also there is a restriction. Long-term capital loss cannot set off against short-term capital gains, but short-term capital loss can set off against what? Long-term capital gains. That is allowed to set off. And last over here is loss from the activity of owning and maintaining race horses. Sir, what does it say? It says very simple thing that if there is a horse race business for you, then the loss can be set off only against a similar business income. It cannot set off against other business income. And it can be carried forward and set off for how many years? For 4 years. And this section is very specific for horse race. If apart from horse race, you are engaged in the business of any other animal race like camel race, etc., then that will not be covered here. That can be considered as a normal business under Section 72 and you can carry forward and set off that for 8 years. This will not be covered over here. This is exclusively for horses, not for other animals. I hope it is clear to all of you. Okay. Now, the next one is the section is the reason why we are doing this chapter in CA final. Otherwise, this chapter is exactly same as CA entire. Section 79 is a very important section which is applicable for a closely held company. Now, if you are a closely held company, then what does this section says? Section 79 says that the year in which you incur the loss and the year in which you want to set off the loss, in both the years, at least 51% of the shareholders should be same. If the 51% of the shareholders are same, then only you are allowed to set off the loss. Otherwise, you are not allowed to set off the loss. Say for example, in previous year 22-23, I incurred a loss. So I have to check the details of the shareholder on the last day of the previous year 22-23. That is 31st March 2023. What is the shareholder pattern? Now in the year 23-24, I want to set off that loss. So again, I have to check the last day of the previous year in which I want to set off the loss. That is 31st March 2024. Now 31st March 2023, 31st March 2024, at least 51% shareholder has to be same. Otherwise, the loss will not be allowed to be carried forward and set off. Now, certain changes are not considered as change for the purpose of Section 79. That is, if there is a death of the shareholder and if the shareholder changed because of that, that is not a change as per the income tax law. Okay. Or if you give the shares to your relative, if you give the shares, then that is also not a change under the income tax law. So if you give to relative, if you give to some other person, then it is a change. If you give to relative, then it is not a change. Gift is also important and relative is also important to not consider it as a what? As a change under the income tax law. Third point, very important. Pay attention, please, all of you. There is an Indian company which is there in India and there is a foreign company which is there in say USA. Now that foreign company is a parent company and this Indian company is a subsidiary company. Now that foreign company is getting amalgamated with another foreign company in UK. So the US foreign company is my parent company. I am subsidiary. US company is my parent. Now that company is getting amalgamated with what? Another foreign company. Now the question is, in that case, my 51% shareholders will change. Today, my 51% shareholder is a US company. If the amalgamation happened, my 51% shareholder will be UK company. So in that case, the government said that your loss will not be lapsed. Don't worry. If 51% shareholders of the amalgamating foreign company
continue to be the shareholders of the amalgamated foreign company. If 51% shareholders of the US company becomes the shareholder in the UK company, then your loss will not be lapsed. Don't worry about it. Okay. And this section is only for losses. It is not for UAD. For UAD, no such restriction is there under the income tax law. Now, for eligible startups, there is an additional benefit. For eligible startups can take advantage of two provisions. That is section 79 clause A and section 79 clause B. What is section 79 clause A? Section 79 clause A is something which I have told you just now. That is 51% of the shareholders have to be same. If 51% of the shareholders are same, the eligible startup can what? Eligible startup under 80 ISC can carry forward and set off the loss. But even if the 51% of the shareholders are not same, even if the 51% shareholders are not same, don't worry. If all the shareholders are common, then also eligible startup will get the benefit under the income tax law. Even though 51% shareholders are not same, at least all the shareholders have to be same. Okay. For example, in 21-22, there are 4 shareholders A, B, C, D. All of them are holding at 30%, 30%, 20%, 20%, 3 lakh, 3 lakh, 2 lakh, 2 lakh. Total 10 lakh capital. Okay. Now, in the next year, the company has raised some funding round. Okay. From the investor, they are raising some money and 4 more investors have come. E, F, G, H, 4 investors have come. Now, in this year and in this year, is the 51% shareholder same? Not same. That is covered in 79A. But are all shareholders common over here? Here also 4 shareholders were there. Here also 4 shareholders are there. That is sufficient. For startup, even this condition is sufficient that even if all 4 shareholders are same, then also startup will get the benefit of what? Carry forward and set off of losses. 51% shareholder is there. Along with that, if 51% shareholder criteria they are not able to fulfill, they can at least fulfill the criteria of all shareholders being the same. Okay. That is also sufficient for a startup company. Now, for some companies, this section is not applicable. There are 4 types of company to whom this section is not applicable. First company is who has applied for what? A bankruptcy and insolvency code. A company who has applied for revival under insolvency and bankruptcy code 2016, for them this section is not applicable. Second company and their subsidiary and subsidiary of such subsidiary who has been, what has happened against them? A company, a subsidiary of company and subsidiary of such company, whereby the central government has moved a petition, to NCLT, and then the NCLT has suspended the board of directors of such company and appointed new directors, and there is a change in the shareholding in case of such companies and subsidiary of such companies and subsidiary of such companies, section 79 will not be applicable. And both these companies, that is first company and the second company, that is IBC wala company and this NCLT disqualified the directors of the company, that company. Both the companies under 115JB also, generally in 115JB you are allowed to set off the loss or UAD, whichever is lower as per books of account. But for these companies, both unabsorbed depreciation and loss, both will be allowed under the income tax law to be set off. Both is allowed to be set off under the income tax law. Okay. The third company is covered, the third company has been brought for Tata. That is for acquisition of Air India by the Tata. Okay. So in case there is an erstwhile public sector company which is getting what? Which is getting sold to another private company in the form of a strategic disinvestment, and the 51% shareholders of the companies are going down, for them also this benefit is continue to be available. So if there is a public sector company like Air India which is getting sold to what? Which is getting sold to Tata, and if the 51% shareholders are not same, still they will take the advantage of this section. And company number 4, I will not be able to talk now. For that, we need to see point number 7AC and 7AD of section 47. Whenever we will talk about that, at that time we can talk about it. Right now, I cannot speak about it. You will not understand also what exactly I am trying to say now. Now, there are some general notes over here. Let me address that one by one. First, losses cannot be set off against lottery income. Definitely. Losses cannot be set off against the income covered under 115BB, which we have done in the chapter of penalty, if you remember. Okay. Further, losses must be set off in the immediate succeeding year, and it cannot be carried forward for succeeding years. Okay. So if I am incurring loss in the current year, I have to set off in the next year. Okay. If next year there is an income, I have to set off. I cannot say that I don't want to set off now. I will set off in subsequent years. Not allowed. Okay. Next, section 79A. Section 79 say what? If there is a search in your business, or there is a requisition in your business, or there is a survey in your business other than TDS and TCS survey, and there is undisclosed income found in your business, then against this undisclosed income, you cannot set off any loss. You cannot set off any unabsorbed depreciation against this undisclosed income. Against the undisclosed income, you are not allowed to set off any loss. You are not allowed to set off what? Any unabsorbed depreciation. This is what this provision wants to say. Nothing great is there. Okay. One last thing is a Gujarat High Court judgment, which is as follows. I'll tell you the facts of the case and then I will tell you the judgment. What has happened in this case? The SLC was engaged in production and manufacturing of fertilizers. Now the government of Gujarat came and told the SLC that you have to sell the fertilizer at a slightly lower price. The SLC said that if I sell the fertilizer at a slightly lower price to the farmers, I will be under loss. Who will bear my loss? The government said that don't worry, whatever loss you will incur, you tell us, we will give you what? We will give you fertilizer bonds against that. You can sell those bonds and liquidate the money. Okay. So the Gujarat government gave what? Fertilizer bonds to the manufacturer of fertilizers. For what? For selling the bonds at lower than the market price, so that the farmers can get the advantage of cheaper fertilizers. So therefore, I am a farmer, I am a fertilizer manufacturer. Gujarat government gave me fertilizer bond. Now I sold that fertilizer bond. When I sold that fertilizer bond, I sold at loss. So what is the treatment of that? Loss. Whether that loss will be treated as a capital gain loss or whether that loss will be treated as a business loss, the Gujarat High Court said that this is a loss on sale of fertilizer bond issued by the SSE, issued by the government, will be treated as a business loss. It will not be treated as what? It will not be treated as a capital gain loss, and it should be treated as what? As a business loss and business loss. I hope it is clear to all of you. Last but not least, what should be the priority of set off of loss under the income tax law? Always first you will set off current year depreciation because it is mandatory to claim depreciation. Then you will set off current year capital expenditure on scientific research, current year expenditure on family planning to the extent it is allowed. Then you will set off brought forward losses, okay, because it will expire in 8 years. And then you will set off unabsorbed depreciation, unabsorbed capital expenditure on scientific research, and unabsorbed capital expenditure on family planning. All of them are same to each other. Okay, let's move on to the next topic, which is a small topic but a very important topic in CA final examination. Taxation of investment funds, AIF 1 and AIF 2. We say that as alternative investment fund category 1, category 2. What is this exactly? There is a fund which raises money from public and then invest in the market. Market means in business or in house property or in many other places. And whatever profit is earned, it will distribute entirely to the investors. Okay. So now we need to talk about the treatment in the hands of the fund also and treatment in the hands of the unit holder also. Okay. So let us talk about the first thing. If PGBP income is earned by AIF, that is fund, then it will be taxable by the fund itself. So on PGBP income, fund will pay tax and the investor is exempt in PGBP income. Investor will not pay tax. Section 10 exemption is there for investor, and if Section 10 exemption is there, even MAT will not be applicable in the hands of the investor. Okay. Now, if other than PGBP is earned, like if HP is earned by fund or IFOS is earned by fund or capital gains is earned by fund, then it is exempt in the hands of the fund and it is taxable in the hands of the AIF. And in the hands of, it is taxable in the hands of the members. In the hands of the members, how it is taxable? Under which head it will be taxable? It will be taxable under the same head as it is earned by the AIF. If it is earned by the AIF under capital gains, member will also pay tax under capital gains. IFOS, HP, HP. It will be taxable in the same proportion. And therefore, the fund has to deduct TDS on this income. On PGBP income, fund will not deduct TDS because PGBP is exempt in the hands of investor. But in case of other than PGBP, HP, CG and IFOS income, the fund has to deduct TDS. Now, how much TDS? Now, the TDS will be deducted under 194 LBB section. This is the section under which TDS is deducted at the rate of 10% if the investor is resident and at rates in force if the investor is non-resident. Rates in force is not defined here. Rates in force is defined under the Finance Act. Okay, you don't have to remember that. Now, what about the loss? What will happen for the loss? Loss will also be given to the investor. Now, that depends upon which loss it is. If there is a PGBP loss incurred by the fund will carry forward and set off. Okay, because PGBP income is taxable in the hands of fund, so PGBP loss will also be carried forward and set off by the fund only. It will not be passed on to the investor. What about other losses? Other losses depends. Other losses depends. If there are HP loss, if there are CG loss, if there is IFOS loss, in the current year fund will only set off. In the current year fund will only set off. Be very careful. If there is HP loss, if there is CG loss, there is IFOS loss. In the current year fund will only set off. And after that, if there is any balance, then who will carry forward? Here the question will start. The current year fund will only set off. And if there is balance left, then who will set off? Then who will carry forward and set off? That depends upon. If the investor is more than 12 months old, then it will be given to the investor. Okay. If the investor is more than 12 months old, then it will be given to the investor. It will not be given to the fund. Okay. But if the investor is not more than 12 months fund, not more than 12 months old, then the law is very silent about it. Okay. It cannot be given to the investor. It cannot be given to the fund also. Nobody knows where it will go. Okay. So if there is a PGBP loss, fund will set off. Investor will not take. Other losses, first of all, you have to check how old is the investor. If the investor is more than 12 months, give the loss to the investor. After setting off currently, after current year set off, carry forward will be done by the investor. Okay. Carry forward will be done by the investor. But if the investor is not more than 12 months old, then the law is very silent about it. Okay. Be very careful. So what is the tax rate of AIF? That depends upon how AIF is registered. If AIF is registered like a company or a firm, then the tax rate will be 30%, 25% as the case may be. But if the AIF is registered other than company and a firm, then the AIF is liable for maximum marginal rate, that is 42.744%. Okay. Now there is a concept of deemed credit for AIF. What is deemed credit? Suppose if AIF earns 100 rupees of HP income, IFOS income, CG income, Now these incomes will be taxable in the hands of investor. Okay. Now whatever income is earned by the AIF, that entire income will be what? That entire income will be what? That entire income will be taxable in the hands of the investor today itself. Today itself the investor will pay tax. Suppose if I have earned 100 rupees as HP income or IFOS income or CG income, and that entire 100 rupees will be deemed to be the income of the investor. Now whether I distribute 100 or distribute 80, it doesn't matter. Even TDS has to be deducted on the entire amount. Be very careful. Suppose if I gave you what, if I have earned 100 rupees and if I distributed 100, I will deduct TDS on 100. But if I earned 100 and if I distributed only 70, then also I will deduct TDS on entire 100 rupees. Okay, entire 100 rupees. You will also show entire 100 rupees. Next year when I will distribute the remaining 30, you are not going to pay tax on that remaining 30 because in the last year you have already shown that on a deemed credit basis. I hope it is clear to all of you. Okay. Now if any income is exempt in the hands of AIF, that will be exempt in the hands of unit holder also. I hope it is clear to all of you. Okay. And last but not least, who is an AIF? An AIF is nothing but a company or an LLP or a trust or any body corporate incorporated in India which has been granted a registration as category 1 or category 2 AIF under the SEBI or under the IFSC Authority Regulation Act 2022. Okay, I hope it is clear to all of you. One last thing that I am going to address today, that is taxation of securitization trust and its investor. Let me explain you with the help of an example this also. What is a securitization trust? Suppose there is a bank over here, okay, SBI. Now SBI has given a loan to a customer for 20 years. Now in 20 years the customer will give you the EMI in 20 years, okay, slowly. Now SBI wants money upfront today. So SBI makes one securitization trust, okay. What is the role of this securitization trust? This is a separate SPV, special purpose vehicle. It will raise money from public. SPV will issue securities to the public, to the investors, and investors will put money in SPV. And that money SPV will use to pay what? To the SBI, and SPV will take the debtors of the SBI. So again, there are 4 players over here. There is SBI, there is a customer of SBI, there is SPV, and there is an investor. Investor will give money to SPV, and SPV will use that money to give to the SBI bank and will buy the debtors from the SBI bank. Okay. And now this activity is known as activity of securitization. Now whatever income the SPV will earn, whatever income later on, whatever EMI the customer will pay to the bank will transfer to the SPV because bank has sold the customer to SPV. So all the EMIs will go to whom? Will ultimately go to the securitization trust, that is SPV. So whatever securitization trust has earned through the activity of securitization trust, whatever income is earned by securitization trust through the activity of securitization, it is exempt under section 1023 DA. It is exempt under income tax law. Okay. Now the second thing, let me tell you. Now suppose if securitization trust has earned 100 rupees. Now the entire 100 rupees will be deemed to be in the income of the investor. Now whether 100 rupees is distributed or not distributed, just like AIF, whether 100 rupees is distributed or not distributed, it is deemed to be income of the investor. If 100 rupees earned by AIF, and if 70 rupees is distributed, still 100 rupees will be taxable in the hands of the investor. Or if 100 rupees is earned and 100 rupees is distributed, still 100 rupees will be taxable in the hands of the investor, just like AIF. And what is the rate at which the TDS will be deducted? That is given under 194 LBC. If the investor is resident individual and HUF, then 25% TDS will be applicable. If the investor is resident but not individual and HUF, it is company, firm, LLP, then 30%. If the investor is non-resident or foreign company, then rates in force. Then the rates will be rates in force, which is mentioned in the Finance Act. The investor can give a lower deduction certificate, and accordingly, I will not deduct the TDS. Okay, this is what this provision is all about. Now, I have done one interlinking over here, that the concept of securitization trust and in AIF, that is the previous chapter, in both this concept, in both this chapter, there is a concept of what? Deemed credit. I hope you understood the concept of deemed credit. Deemed credit means if I earn 100 rupees and if I distributed only 70, still entire 100 will be taxable in your hand, and I have to deduct TDS also on entire 100 rupees. So in both this chapter, there is a concept of deemed credit. But later on in book 2, there will be one chapter by the name called as business trust. In that chapter, there is no concept of deemed credit. In that chapter, only the amount which is paid, that will be taxable in the hands of the other person. It is not taxable on accrual basis. Whatever is paid, if I paid 70 out of 100, only 70 will be taxable. I should deduct TDS also on 70 rupees. So in business trust, there is no concept of deemed credit. But in these two chapters, there is a concept of deemed credit. So I hope it is clear to all of you. So like this, we have done the revision of lot of topics in this particular video. That is all the assessment of various entities, profit link deduction, MAT, AMT, penalty, dispute resolution committee, set off carry forward,
then AIF and securitization trust. So I hope you all are enjoying the English revision videos. If yes, it is my sincere request to all of you that please share these videos with all your friends of South India who are struggling to get what? Revision videos in English. Definitely you're not going to get any revision video in English which is so comprehensive and so detailed on the entire YouTube. Okay, so please share this with your maximum friends across South India. I will be coming up with the later videos as I promised you. I will be uploading all the videos in English also along with Hindi. It is my duty and I will do it. Don't worry about it. Okay. So take care all of you. Till then, I'll come up with the next video soon. Take care all of you.